how Asia seems to be faring right now, and it's not great. In the red largely, but the Nikkei, of course, hit the most. But let's get in a take from Peter. He's CEO XM Australia. Peter, very good morning for us, but of course, good evening to you. Thank you for joining us, on the show. Can I just get a sense of whether we are seeing a momentary issue over here in terms of the crude spike, or are these now factors which could carry on for a while? Because Middle East crisis has been happening for a while. Ukraine-Russia conflict has been happening for a while. OPEC producers wanting to hike prices and cut production has been happening for a while as well.
Well, good morning, Tamanna. I think it's many things, and you've probably added, there's maybe 3 or 4 others that you could probably put in there. And we're talking also, we've got to be really mindful of the situation. It's been, I think, oversold to some way. We've had a nice rally to the upside, and you've had those geopolitical concerns come in, confirmation as far as OPEC plus, and overall demand is relatively strong. And I think the producers are probably wanting prices closer to that 85 to 90. And then you're rolling geopolitical tensions in there, which in turn could make that, that 95 handle very achievable in the short run.
Peter, good morning, Niraj. Good afternoon to you, Niraj here. Now, keeping all of this in mind, but the fact that the Israel-Iran issue is simmering now, and we don't quite know which way it will move, do you reckon that there are upsides for crude purely based on sentiment, if not actual demand?
Well, I think so, Niraj. I think there's, that war premium / geopolitics is always one of concern. And we're also mindful of the Persian Gulf and the transporting of crude through that region. The overall hostilities still hasn't been put to bed as far as the Houthis, what's going on there. So it's just a combination of many factors, and that's led to, that spike in price. And no one knows how much further it's got on this particular roll. But I think there's probably a few dollars left in it yet, and then maybe it'll just have a little bit of a breather unless you see something dramatic happen from a geopolitical concern.
In terms of how far the Brent could go, Peter, would you reckon that, it's not too much of an upside above 91? Do you see the possibility at all of crude back at $100 a barrel?
Well, look at the big guys. I mean, JP Morgan have come out and said it's quite possible you could see 100. Many are saying 95 is achievable, Tamanna. And I think that that's probably what the appetite's going to be over the next month or two leading in this second quarter. It's been a very rocky road to start this quarter. And I feel as though that, yes, I would be erring on that side, 90 plus over for the rest of the quarter. And if you get wild swings with geopolitics rolled into it, then, probably 100's very achievable.
Yeah, 100 achievable. Some of it would be, force-fitted because of the OPEC plus trying to push production cuts, and the others, of course, geopolitical tension simmering. Thank you so much, Peter Macquarie. Always a pleasure to have you on NDTV Profit, and great to speak with you today.
Thank you.
All right, so $95 to $100 not cut out. Now, the question is that how much of this is going to have an import today? Because for the last couple of sessions, Niraj, Indian markets have been marching to their own beat. Yeah. Impervious pretty much to other things that are happening. And the story this morning is HDFC. I don't know if you can pull that up. HDFC ADR as high as 7%, as at one point as high as 7%. Yeah. Overnight. Yeah.
So some bit of it, Indian markets may be factored in over the last 2 days, and therefore this also happening. But yes, you're right. Financials per se have actually had a pretty strong run. And if that continues, it's a bit of a support that the markets really wanted. But somehow something tells me that the oil party might still disrupt, the oil uptick might still disrupt the Indian party in the very near term. Keep in mind, oil, geopolitics and the US markets correcting led to global volatility really shooting up in trade. That's usually something that brings the market lower. But almost anybody that you speak to talks about India now being a market on dips. I think the markets have laid out the proof that India is a market to be bought on dips and not to be sold on rises. And I think that is what will weigh in the mind of anybody who's wanting to open a short, especially in the 2 periods 2 months of election as well as results coming out. And results, by the way, thus far have looked very strong, right? I mean, Tamanna was talking about HDFC Bank. That's exactly the point. If Citi's note on IndusInd Bank today is an indication of 30% upside, Bajaj Finance numbers looking strong. So the numbers are looking strong, which is a good positive for India. Oil upstream and defense could buck the trend today, to be honest. Yesterday, by the way, in the US, the defense stocks actually had a fabulous run. Midway through the day, the defense stocks spiked to days highs. Now, does that happen in India as well because of what's happening to tensions? Because a lot of Indian defense companies are suppliers to global companies now. So that's the other interesting piece. And just what's kind of buckled down after showing some signs, to my mind at least, Tamanna, is FMCG. And if Dabur is any indication of what's happening to the space, it need not be, but if it is, then bottom fishing in FMCG could get delayed because the commentary, the numbers left a bit to be desired. The stock corrected yesterday, yes, but is it symptomatic of what could happen to the other FMCG players? That's the key question. And does that kind of derail the slight uptick that we're seeing in FMCG?
Yeah. So absolutely. Dabur saying that, yes, rural growth is picking up, but it's sluggish. Demand is sluggish. That's a problem. I just want to quickly, take you through what the implied open is indicating. And yes, you are possibly, like most of Asia, going to have a negative start for India as well, about 75 points down. Now, yesterday was an interesting day because you closed, fairly decently. What was the kind of fund flow is what we should look at, because you closed 80 points up on the Nifty. And here's the interesting bit. It was all about HDFC, it seems. HDFC and TCS, because FPIs, DIIs, both were sellers. FPIs, remember, last 4 sessions have been consistently selling, and DIIs were sellers yesterday as well. But I think in terms of now the stocks that are going to be in focus, HDFC could have another fabulous day. Like we were mentioning, the ADR was up overnight as high as 7%. The positive sentiment on the robust quarterly business numbers will continue. In fact, a large number of notes this morning as well, Niraj. I'm just going to go through what Nomura is saying. They've reiterated a neutral on HDFC, target price at 16.25. So they're seeing about a 6% upside. They said the gross loan growth was soft, but everyone's looking at the deposit growth. It is a seasonally strong quarter, but the deposit growth at about 11% is cumulative, is being seen as good. LDR has come down 600 bips, and the rundown of low-yielding corporate loans will be aiding NIM. So HDFC is a big one, a lot of other notes, but the HDFC of the day could be BAF. Now, if that's confusing, I'm saying Bajaj Finance and their business updates are completely rocking. So you have AUM growth above 30% consistently. And I think that's, I think Harsh was mentioning the last 4 quarters or some such, and we'll get him in for more details. Deposit growth is up 35% year on year. Jefferies has maintained a buy with a target price of 9,400 for Bajaj Finance. That's nearly a 30% upside. It's their key topic in NBFCs. They say that the pre-quarter update shows a robust AUM growth above estimates, and growth in customer base is also healthy. Citi has a buy rating with a target price of 8,975 for Bajaj Finance. They say the consolidated AUM is showing sustained, robust traction. They're happy with the ROE, ROA numbers as well. Bank borrowings have become expensive, and NIMs to have probably declined. Now, the fact that RBI's guidelines on, sort of toning down loans to smaller segments has already been factored in. Bajaj Finance saw that price correction, so maybe that's not too much of a concern. A couple of real estate names have also seen some interesting traction, but I'll come back to that, Niraj, after what's on your list.
Yeah, I mean, so financials across the board. I mean, I just thought IndusInd Bank, the other one, right?
Yeah.
I mean, the loan growth maybe from a 20% is lower at let's say 18%. Is that I mean, is that a sign, or is that an indication, or is that a derivation that we've gotten that by IndusInd Bank the slight moderation is reflecting of RBI asking the bank to moderate the unsecured loans and LDR maybe. But Citi believes that it's a great number and their target prices are 30% higher. So banks and financials right up there. Yesterday we were talking about Suryodaya Small Finance Bank. Today we are talking about ESAF Small Finance Bank, and look at those numbers. I mean, again, a small number, but the total deposits at 19,000 crores up 35%. Gross advances 18,000 crores, 34%. Obviously, it's a very small base for a financial institution, but yet this 35% growth may get rewarded. So that's to be watched out for. And one more update before we move on to other stocks and other newsmakers. Maybe Tamanna has more actually, but one more update that I thought was interesting was Sobha. By the way, Kalyan Jewellers this morning seemed okay, but Sobha is the other one. The pre-sales numbers of 1504 crores is flat YOY and down about 23% quarter on quarter. Now, this could well have happened. I mean, this is, this number is happening after some 10 straight quarters of some very strong gains. Now, this is probably because of spillover launches. A couple of launches that Sobha did were in the month of March, and therefore they may not have been able to capture in the month of March. Maybe April, May, June could be strong. We'll try and get the company to talk about it. So that's the other thing. But sales volume for the quarter as well, 1.3 million square feet, down 9% YOY, 19% QOQ. Does the street give it a benefit of doubt, or does the street punish the stock today on what could turn out to be a slightly iffy day? I think that's the question. So let's wait and watch there.
With Sobha, Prestige is the other one which has an update. We spoke with the management, Irfan Razak, recently. So they've acquired 21 acres of prime land in Whitefield, Bangalore for residential development of 4 million square feet. Real estate has overall been down, and today with the policy coming in, rate sensitives may be under traction. No real hike is expected, but even so. Just to come back on the financials, because that is the story of the day. Look at Nomura and Bandhan Bank. They have reiterated a buy with a target price of 275 on Bandhan Bank. And that's nearly a 40% upside. They say gross loans and deposits have registered strong growth. This is again on the back of business updates. Retail and bulk deposits saw strong growth. Collection efficiency in MFI improved. Likely moderation in slippage run rate, and monitorable for Q4 will be, of course, consistent delivery on asset quality. But you could see an uptick there. Citi has retained a buy on Aavas with a target price of 1830. That's another one that I would watch. The AUM growth is in line with their estimates, and they forecast an AUM growth of 24 to 25% for FY25 and estimate of 26. So a clutch of financial stocks. But speaking about the space, the other big event, of course, today.
Just before that, Tamanna, just before that, two small stocks that we need to, because they'll react today. Rashi Peripherals, watch out for that one. They received new orders worth 1,510 crores from an NMDC data center. Somehow, this could well turn out to be a stock that starts off higher, because the market cap is 2,200 crores. The annual sales number is way lower than this order size, so watch out for this one. And watch out for IOL Chemicals. They've been issued a certificate of sustainability for gabapentin, which is gives them a great mix in the European regulated markets with higher margins. So IOL Chemicals is the other one. Okay,
so those are a couple of smaller companies, but you might see big moves there on a day like today, depending really on where the market mood moves. The big story, though, this morning is the monetary policy, and I'm going to go across first to my colleague Vishwanath Nair, who's joining us live from the RBI headquarters. Vishy, first up, it's the first policy of the new fiscal year. I mean, for the governor, obviously they've already decided what they're going to say, but they're talking about this on a day when crude is hit 91, and inflation fears will loom.
Yeah, that's right, Tamanna. So that's going to be one of those issues that the RBI and the MPC, the Monetary Policy Committee, is going to be burdened with in the upcoming policy. So remember that as far as India's inflation numbers go, it's about 5.1% as of February, and that has more or less given a lot of comfort to people to say that okay, maybe inflation is not such a bad position right now. Food price fluctuations were a concern. fuel was remaining more or less stable. Now, of course, the fuel component might see some volatility. Added to that, because of the weather phenomenon in India, because of the high heat waves that are expected in the later part of the year, you may see some agri output impact as well, and therefore your headline number might not moderate as much as what one would have expected. Now, the RBI, of course, has repeatedly said that the job on the inflation front is not over, that the target for the retail inflation is 4%. We are still at about 5.1%, and that last 100 bips, the last mile of the inflation management problem, that is something that's where it becomes tricky, and the RBI is going to be active on that. As far as the other factors go for the MPC, for example, the liquidity position, it did tighten for a bit in December and early January, and since then it has started to sort of taper off. Liquidity is looking better because the upcoming months are election months. You're likely to see that liquidity position remain largely stable because there will be some election spending that will likely happen from all political parties. Apart from that, if you look at where the credit growth in the banking system is concerned, that's still strong at about 16%. You've got deposit growth slightly picking up now with banks revising their deposit rates. That transmission problem that the RBI governor pointed out last policy, that seems to be waning a little bit, but we still haven't seen the full pass-through of past rate hikes. So a multitude of factors indicating another pause. Of course, the Fed, US Federal Reserve, has also not indicated any upcoming rate cuts. I mean, the market is expecting at some point in June, but there's no, it's not a definitive yes. So we still need to wait and see how the global central banks act on the interest rates, and then have to see how the MPC weighs these domestic factors before they take a rate call.
Okay. Vishy, thanks, and we look forward to your questions to the RBI governor during the press conference as well. That's Vishwanath Nair, banking editor, talking about what to expect. Well, let's get in somebody we love talking to during such instances. Lakshmi Iyer, CEO, Investments and Strategy at Kotak Alternate Asset Managers, joins us right in the studio to talk about her thoughts on what is usually a big day. Could today be a big news-making day, Lakshmi, from the Reserve Bank governor or the MPC?
I'm not too sure, Niraj, if it's going to be a big news-making day. Yeah, of course, there are breaking news as far as commodity prices, specifically crude, which is concerned. And that can obviously be a little bit of a bummer when you are at the D-Day in terms of announcing your policy and the first policy of the financial year, where you will, probably give expectations on the inflation trajectory, which is looking good so far, so far from India. In fact, I tweeted also this morning that India is an oasis in the desert as far as inflation is concerned. But will India want to precede the Fed as far as rate action is concerned? Looks very unlikely. Yeah. So I'm not too sure if it's going to be like anything out of the whack. If at all, things are looking a little bit spooky. From the previous policy to now, I think they're about, 15-16% up on crude oil prices. Larger scheme of things may not be a big worrisome factor, but if you look at the pure sentiment, I think, soft commodity prices are up, tomato, onion, all these prices are also, inching upwards, and it's the summer time of the year.
And growth isn't looking bad.
Yeah, and growth isn't looking bad. So if you have that kind of Sone pe suhaga kind of moments, then why would any central banker want to ease rates?
Yeah.
Not really necessary to just gratify the markets, very unlikely.
So there is no real case for a rate cut. Anyway, we weren't penciling, I think nobody was penciling in one right now. The question is whether they will act before the Fed. The Fed doesn't seem clear what they're going to do, so we'll leave that aside. What is the commentary that you're looking out from? Apart, of course, the questions that Governor Das will be fielding on what he's doing with currency derivative trade, and we'll come to that. But what is the commentary that you're looking out for in terms of economic growth outlook as well as inflation?
So growth seems to be on a reasonable footing. I think that can continue. I don't think there's going to be any change on that front. Inflation also, if you see, just after the policy, a week later, we will have the inflation numbers. In all probability, that print could be sub 5%. And if you look at the next quarter, which is the July to August quarter, there could be a brief period where the print could be even sub 4%. So I think, given
why is that? It's a base effect.
Yeah, it's all of that put together. So I think that part may not be, such a big that big an issue. But we've also seen that while domestic factors do hog center stage, it's also important not to ignore what's happening globally. And in some sense, Fed is behaving like Lapata ladies. I mean, they're kind of talking about 4 and 5 rate cuts in terms of markets expectation, now down to maybe 2 or, I don't know, maybe none. You don't know?
So, Lapata ladies is the term of the day coined by Lakshmi. I heard, like, fabulous. So, Fed is acting like Lapata ladies. There's no reason why the RBI should follow these Lapata ladies. So, then let's look at our own sort of traction and our own sort of timeline. When do you think that we can pencil in a rate cut, if at all?
So today the markets may be looking out for some sort of a guidance in terms of when that could happen, but looks like the indications could be still non-committal because there's so many things happening across. And as I said, when you have growth on a strong footing, there is no real necessity to guide the markets towards a rate cut. And look at the appetite for government bonds, pretty strong.
Yeah, that's true. Just wondering, Lakshmi, on the growth front, the belief at the start of 2024 for many quarters was that will the RBI need to step in to support growth. Now, without that happening, the PMI numbers, etc., indicating that growth is strong, not just in India, picking up across the world as well. Could that be a reason for delayed rate cuts for the rest of the year as well?
Why not? Is Indian growth solely dependent on rate cuts? Probably not. It could be a small catalyst to probably nudge that growth. But if you look at, I mean, we've had Q4 is obviously results are underway. Q3 just went by. And the earnings were not so bad. I mean, I'm talking about the broader thing. Of course, there were sectors which were a little bit in the down. So I think, is that the sole reason that if there is no rate cut, will growth really suffer? Probably not. But yeah, it's a feel-good factor. You would love to see your EMI costs going down. All of that is not happening right now. Yep. But I think that gratification will need to wait.
Just your take on the currency derivative rules back and forth. Now, that timeline has been pushed from April 5th. It had to kick in today to May 3rd. After a lot of concern from traders, etc., does this push to May 3rd give some reprieve? What do you make of the flip-flop in this entire case as far as the RBI's actions and communications are concerned?
No, it does give some respite, no doubt about it. And also the fact that, if there is a larger, I would say investor interest at play, it just makes sense to probably take into cognizance all of those before you probably crystallize what you really want to do. So that seems to be the way. And I think that's a fair practice which the regulator has actually done.
But so it's just postponing the death knell of this entire category by a few weeks.
Well, we don't know it's death knell or otherwise, but...
you think it will survive if the volumes come down, the estimates volumes will come down?
See, everything 70%. Is relative, every time a regulation comes in, there are, entities or skeptics who end up calling doomsday for the industry, whether it is, exit load going, entry load going away from mutual funds, or lock-ins coming, or, exit loads coming in for liquid funds. I think all of that, we've been there, done that. It's par for the course. Every regulatory change takes its time to acclimatize. So it's just about acclimatization. So yes, I'm not saying that there will be no impact, but yeah, I mean, whoever said that regulations cannot have an impact.
Lakshmi, one word on what happens if indeed the inflation numbers, let's say crude is, I'm kind of sticking back to inflation. Let's say crude uptake is transitory and it kind of cools off as well, but growth numbers at the same point of time continue to look strong. You think the bent should be towards cutting rates if inflation allows it, simply because one school of thought is, why should we be happy with 6.5, 7? Why shouldn't we gun for more?
7? 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, 7. 6.5, That thought process is not completely incorrect, but I would just say that if the globe is not really supportive and we are now very well perched, as far as the foreign exchange reserves are concerned, we were at $640 billion September 2021. We're almost there at the same levels. Why would you want to really distort the apple cart when things are going good? So that's I think, why would anyone want to kill the hen that lays the golden egg? So if things are going good, you're in a golden phase as far as growth is concerned, and just by cutting rates, is that going to accentuate additional? What's the delta? Yeah. I think that's the way one should really be thinking as a policymaker.
I think one realization also has been the relatively high tolerance to higher interest rates in terms of economic growth, right? That has now been seen over the last several quarters. That it's not like there's been a big hamper to growth. So you're right. If Governor Das today and the policy committee is thinking that why should we rush on cutting rates, if at all? Yeah.
Yeah, great. Lakshmi Iyer, thanks for putting all of this into perspective for us. A lot of ammo to hear the RBI governor's speech and see what comes out of it. And look forward to have you the next time.
Every time policy comes in, Lakshmi, you have to come in the morning. It's just fantastic.
We're just taking you for granted right now.
No, I'm just trying to put in pressure. No.
Yeah, we are good at that.
We'd love to have you. Awesome, it's fabulous to have you.
Thank you so much.
Thanks, Lakshmi.
Yeah.
All right. Well, that's the expert opinion on what to expect from Governor Das and the MPC. The lineup for today, post policy, you'll of course hear Jayesh Mehta, VC and CEO, DSP Finance, Tanvi Gupta Jain, UBS India economist, and Niraj Gambhir of Axis Bank talking to us as well. Time for a quick break. Up next, Agam Vakil, as usual, joins in to talk about the derivative setup and what you should expect from the FNO side, and in particular, some option strategies.
right, that's the gentleman who's perhaps going to move the markets. Governor Shaktikanta Das's statement watched very, very carefully. You know where to stay and come to live when you want to know what's happening in the monetary policy. We'll, of course, break it down for you at 10 o'clock. We can hope for those comments to begin. But meanwhile, a quick look at the implied open before I get to Agam's take on what to expect on the F&O side of things. Yeah, we're looking like we're down for a bit of a negative start. We'll see how that holds, though. Agam, are you seeing those indications as well?
Actually, I wasn't, because yesterday it turned out to be a good day of trade and there were a lot of levels that we had taken out, in fact. The real question is that if this implied open indicates, well, a negative opening, can we expect a recovery from there onwards? That's perhaps something that we will know in time. And of course, the first hour of trade will also likely see consolidation, because markets will await the rate decision, where we are not expecting too much, but also, and perhaps more importantly, the commentary from the RBI governor as to what is in store. And that perhaps could eventually lead to some sort of reaction in the markets. That said, when it comes to markets yesterday, it was in fact a good day of trade. We started off at a life high, we came off substantially, and then eventually we covered back with the Nifty closing marginally in the green, where there was unwinding in the Nifty April futures. The Bank Nifty futures also saw a substantial amount of unwinding, but the Bank Nifty did move above the mark of 48,000 and closed above that. So that, of course, is another positive there. Now, in terms of the options market, we go into a new week, and I'm going to talk about the Nifty. Well, here is where we saw a lot of traction around the 22,500, 22,600 calls as well as puts being written. In terms of your overall open interest distribution picture, at the moment we do see max OI in the 23,000 call on the higher end and the 22,500 put on the lower end, and that perhaps gives you an idea about the kind of range that at least option writers are looking at as we move into trade this coming week. The range, it seems, has shifted higher for the Nifty. But let's move on and talk about stocks then. And we did see more longs coming through for IPCA, Kotak Mahindra Bank advancing by around 1%, LIC Housing Finance, Bandhan Bank. And in terms of stocks, we saw unwinding. That list for you on your screen, where we did see Hindustan Copper, Eicher Motors and Divi's Laboratories see some short covering coming through. But the real question is, how do you position yourself in these markets? Well, let's get in an expert opinion. We have Akshay Bhagwat of GM Financial, who's joining us on the show. Akshay, good morning. Thanks for joining in. Let's start off with your view on the Nifty and the Bank Nifty. How would you trade them at the moment?
Good morning, Agam. So for the Nifty index, one thing which comes to the mind is that the level of 22,520 and 22,540. If you roughly look at the last 4 days of action, new highs have been registered, but somewhere the prices are facing some resilience around the 22,525 mark. So this is a very important level if you are a day trader. Secondly, from the derivatives data, if you were to look at the monthly open interest positioning for the Nifty index, 22,500 call still holds a significant chunk of open interest on the writing side. So clearly the resistance area is where the Nifty is currently dealing with. We need a clear breakout above the 22,550 level for things to settle or the bulls to go aggressive at the current juncture. Even if you were to look at the FII data in the index futures in the last couple of days, there has been selling action from the FII desk. So this just makes me believe that with the global weakness in the Dow Jones, the 10-year US yield around 4.3%, crude oil above 90, all these factors too would put pressure on the Nifty for intraday trades. My sense is we might have a negative day of trade today. 22,550 is a massive resistance. A small short long unwinding, if you see from the current juncture, can see the Nifty test 22,300 to 22,250 on the downside. So I would advise caution on long bets in the Nifty at the current juncture, especially if you are a day trader. Moving on to the bank index, today all eyes on the RBI policy, how it plays out. But again, if you were to look at the options data, we are dealing with a very crucial resistance, which is 48,000. A lot of call writing positioned at 48,000. Even the prices have a significant resistance area, roughly around 48,000 to 48,200 zone. So I would like 48,200 to be cleared off before I take a buy bet at the current juncture. I would be on a caution mode today, especially Nifty and Bank Nifty. I'm expecting a slight correction, especially in the Nifty index. Bank Nifty, if it crosses and sustains above 48,200, then that will be a buy bet. But if Bank Nifty corrects, expect 47,500 again on the lower side. So caution for both the indices. Stay light, at least as a day trader, for today's session.
All right. Akshay, let's talk about stocks then. I believe you have a spread that you're deploying on Asian Paints.
Yes. So Asian Paints, this would not have much to do with how the indices would play out. A strong base setup around the levels of 2850, 2900. Yesterday was a strong momentum day for Asian Paints, and this would be a beneficiary of the crude oil prices. So my sense is Asian Paints is all set to move for targets of 3100 plus for the April series. You set a bull call spread by buying a 3000 call at 32. Sell a 3100 call out of the money at around 14. And this is a fixed loss strategy where your target potential is around 7,500 and stop loss would be 4,200. That's the trade I would recommend in Asian Paints.
Well, clearly on the max, so we are looking at a higher profit as against a max loss as far as this particular spread is concerned. But actually, you also have, well, what you're deploying a naked strategy as far as Infosys is concerned.
Yes. So, Agam, if you look at the IT pack in the last couple of days, a lot of names have done pretty well. Short covering bounce back is noted in most of the IT names, and Infosys specifically has not seen much of a move. Highly oversold stock in oversold zone, also showing divergent indications on the short-term charts, all set up for a short-term pullback from the current rate. So my sense is that Infosys might be the bet you might consider in the current market scenario. I'm expecting targets of 1540 soon before the results, which is due on 18th of April for Infosys, the quarterly results. So I would play here with a vanilla call buying, because here my risk would be limited to the premium I pay. I would go for buying a 1520 call at the premium of 30. I would target 54. That's my first target. Second target would be 71. And I will have a stop loss of 15 on this trade.
All right, fair enough. Of course, there you have it. A buy call on Infosys and, well, a spread coming through for Asian Paints towards the upside. We've spoken a lot about Asian Paints of late in any case. Akshay, on that note, taking a moment to thank you for joining us and taking us through your views on the markets, as well as helping us with, a handful of trading ideas. With that, it's back to you, Niraj.
Thanks, Agam, for that. I just want to mention a word about Asian Paints. Actually, two things. One, that we discussed on the editor's cut yesterday, Tamanna. Coincidental to the stock mood, of course, but the fact that after such a long time, the PAT CAGR and the market cap CAGR are converging, because until FY21 for 7 years, Asian Paints market cap ran way ahead of the PAT growth. Some 24% uptick in CAGR performance for market cap or share price versus the PAT growth of 14%. Now it's about 16.5% PAT growth for the decade, CAGR, and the market cap growth is about 18%. So it's not completely off. Yeah. And at 40 times, Asian Paints multiples are the lowest in the last 7 years. So fundamentally, now people may not be able to as vociferously argue that Asian Paints is maddeningly expensive because it's a lot more reasonable. This is a valuation chart, and thank you for pulling that. The other thing is something that we may not be able to show here, but our colleague Chinmay showed it to me yesterday. If you look at the Asian Paints 5-year chart, somehow from every April, it tends to move up. I don't know if the 5-year chart right now can show it, but yesterday when you look at, if you draw two trend lines around Asian Paints movements, from the month of April, I don't know if it's because of seasonality or otherwise. You think Asian
summer
Paints,
vacations mein log paint karwate hain? Or
maybe.
I don't know. Is there any logic, or that's the first thing that comes to mind? No, maybe.
Could be, right?
Yeah, it's the right time to, redo at least the residence
Yeah, and look at that chart. So, Tamanna, I mean, this may show a rising trend line, but if you look at the last 4 years consolidation, you see those dips and the upticks that are happening. The upticks that are happening from every dip on the trend line are happening around the month of April. We are in the month of April. Valuations are a lot more reasonable. Could this be the start of the uptick? I mean, Akshay was saying that technically things are looking strong. Could there be a seasonality impact plus the valuation impact, both aiding Asian Paints?
Plus, look at the overhang of what competition will do. Some of that seems to have receded. That, you know, there is a player coming in, a large player coming in. Does that shake up Asian Paints? And now the realization is setting, maybe not really. It's going to take at least, I think at last count, what a lot of analysts have been telling us, at least a couple of years for even a number two to cement their position, if at all. So, yeah, interesting to talk about Asian Paints. But I would say that the one sector which is going to be in focus today is going to be the financial space. The business updates have been mind-boggling. At least brokerage notes are very excited. It's not just HDFC and Bajaj Finance, but a whole slew of them. Harsh is joining us with details. Now, Harsh, before you get into those individual numbers, this is traditionally a strong quarter, isn't it? And that has to be kept in mind?
Yes, absolutely, Tamanna. But nonetheless, despite it being a strong quarter, it's quite a beat when it comes to the overall expectations that analysts had with regard to credit growth. Either it seems to be, the commentary seems to be coming in that it's sustaining, which is also good, which is largely in line, or it's a beat. So that's where the positivity really comes from. When it comes to, I'll start moving to individual names. When it comes to Bajaj Finance, fourth consecutive quarter of 30+% year-on-year AUM growth despite a growing base. So honestly, some of those growth concerns which were there a few quarters ago seems to be receding. Strong growth continues, and this is despite the fact that two of its products have been kept in abeyance, or they're not allowed to distribute those products basis RBI restrictions, and therefore this is a big positive. 6% uptick with regard to the 6% plus, in fact, on a sequential basis. So very, very strong growth. 3.3 lakh crore now is the AUM size. Even in case of customer count, 4% sequential on customers, 21% year over year. So customers also seem to be growing in a good pace. The only piece which is possibly new or different is the new loans booked. That has come off. But it's also likely that they're doing higher ticket size loans, which they've spoken about in the last quarter. Of course, need to wait and watch the commentary as to what is happening there. But new loans books seem to have come off, partly also due to restrictions placed by the RBI. Liquidity buffers improved. Deposits also reinforced. So that growth continues. Last 3 quarters, very strong growth, continues in Q4. I'll move on to IndusInd Bank. Again, net advances growth of roughly 18+%. On the lower end of the band that they've guided for. So decent growth there. Deposit growth also at 4.3%. Your LDR now inching towards 90%. So deposit growth in line largely, but LDR inching towards 90% is something that will push IndusInd to grow deposits going forward. Bandhan Bank, very strong growth numbers. Advances 11% sequential. Deposits 15% sequential. Those are some very, very strong numbers. CASA 18% sequential. So CASA ratio improving as well. This one needs to be watched out for, especially in trade today. We have a Nomura note coming in, 275 being the target price on this one. Very strong. ESAF Small Finance Bank, that one too extremely strong. 10% on advances, 5% on deposits. The LDR seems to have shrunk, but that growth is quite strong nonetheless. And this is sequential numbers which I just mentioned. Last off, I want to mention Aavas Financiers. Again, good numbers. Disbursement growth seems to have come back. 39% sequential growth in disbursements. It seems to have come back well. AUM growth continues, 22% on the AUM growth front. You're seeing gross stage 3, which is improved sequentially by 14 bips or thereabouts. So asset quality will get better, and likely your provisioning will come off as well. So lots of important metrics, all of which are coming out.
All right. Thank you for that, Harsh. Meanwhile, I'm looking at the Puravankara updates. Highest ever financial year sales, up 90% year on year. We'll wait for the details. Highest ever quarterly sales in Q4 at 93% year-on-year on Puravankara. Macrotech also flashed a few minutes earlier.
Yeah, 40% uptick there too.
Yeah.
For Macrotech. In Puravankara's case, it's a bit of a pushback because Q3 was bad, but 90% is strong Q4.
Yeah, we'll have to see the details and obviously we'll know that. But yeah, considering that reality, a lot of people thought ki bas ho gaya na. I mean, how much is there more upside, etc. The numbers are looking good. So we'll have to wait and see how that plays out. Sunny Agarwal, head of fundamental equity research, SBI Cap, with us on the show today. Kush Bora, founder kushbora.com, with us as well. Welcome to both of you. Very good morning. Kush, let me start with you. Exciting day ahead. Global cues are negative, but what are the charts telling us?
Hi, Tamanna. Very good morning to you. Hi, Sunny. Well, it's a very interesting setup. We have a view of 22,500 and 22,800, on the Nifty. 22,500 is here. But just for discussion's sake, if I take out yesterday's move, what's interesting is that from December, some of the momentum indicators are showing a negative divergence, which is suggesting that even though the index is, moving up, inching higher, making new highs, the momentum is just not catching up. Now, typically what this suggests is that, if there isn't a follow through, then, we could be into, a bit of a consolidation mode, perhaps even some profit booking. For now, the kind of buy on dip strategy, that we've been seeing has been working in the markets, and I think will continue to do so. 22,800 is, a near-term target on the Nifty, but I don't think, we'll perhaps, make that in a dash. Perhaps there will be some hiccups along the way, and this buy on dip strategy will continue to work. But I will look for any kind of confirmation whether this negative divergence, does indeed sort of play out. So if we break below the 22,200 mark, would be one trigger to just be a little cautious on the index. But up until then, 22,800 is our near-term target, and we will continue to deploy the buy on dip kind of strategy on the Nifty at least.
Okay. Q4 updates looking strong. Sunny Agarwal with us as well. Sunny, good morning. Thanks for joining in. What have you made of the financials in particular? Because Harsh was just talking about those. Almost every bank or NBFC seems to be delivering very strong numbers, and this was not unexpected. Would this cause, quote unquote, a re-rating? Would this cause some buying into any of the financials that you may have noticed?
Yeah, good morning, Niraj. Good morning, Tamanna and Kush. Thanks for having me on the show. Yeah, definitely a very strong set of number from provisional number from all the banks and NBFC, and that's replicating the systemic growth. So if we track the monthly data of the credit growth number, so anyway, that number is hovering in the range of 14 to 16% for the system, and that is getting reflected across the board. If I have to pick one thing out of this, I mean, one is the Suryodaya Finance bank, wherein they have reported a very solid set of numbers. So YOY credit growth was close to 41% and Q1Q growth was 14%, although a small size bank. And if you look at deposit growth, that was close to 50% year over year and 20% Q1Q. So I think that, and at the same time trading at close to 1.1 time price to book. So this is the one bank which I find, a clear outlier in terms of growth, as well as there is a lot of comfort on valuation, trading close to 1.1 time price to book. So this is the one of my pick. On NBFC side, I would like to go ahead with Poonawalla Fincorp. Again, reported a very strong set of provisional number. So YOY growth of 54% and Q1Q growth of 13% as far as advances are concerned. And what I feel is that this is one of the, best performing NBFC in the current scenario. If I move to a larger size bank, so then I would like to stick with an IndusInd Bank. Again, delivered a very solid set of provisional number for this quarter. Having said that, the general concern on the banking side is when will deposit growth pick up? So right now, most of the banks are lagging on deposit growth. So to that extent, we may see some pressure on NIM continuing in the fourth quarter. But having said that, I think that should bottom out during the fourth quarter, and then FY25 is the year where we will see a stabilization as far as NIM is concerned. The only concern in FY25 going forward is the asset quality. So till now, asset quality has been very rock solid for entire BFSI sector. So going into FY25, whether the asset quality will be maintained, that is to be seen as we move ahead. Having said that, today's commentary from Honorable Governor, RBI Governor, that will be very important, especially taking into account the recent spike in the crude oil prices. So its commentary on inflation and outlook on rate cut will be important parameter to be tracked.
Point well taken. Kush, before we get your ideas, anything on this financial side that looks very good for a trade? The ADR was HDFC Bank ADR. So I'm calling the ADR because that is the biggest contributor. But the HDFC Bank ADR was doing very well yesterday too. Any financials that you would trade?
So, Niraj, repetition is not a bad thing if it does end up making you money, right? HDFC Bank is a trade that we've been suggesting for some time now. 1380, 1400 were the levels. Even now, I don't think anyone's missed the boat. From a positional standpoint, of course, 1700 plus kind of levels are very much in play. But even from a trading perspective, if you look at some of the options data and the technical setup, I think from a near-term perspective also, 1560 is a very realistic target that one can look at. So HDFC Bank is something that I have on my radar. Any kind of tips, I will go ahead and accumulate more.
What levels would you be comfortable accumulating, Kush? Morgan Stanley, for example, has a target price of 1900 today on HDFC. When you say dips, you might not get an opportunity. Our viewers might not get an opportunity for a bit. So what would you do today?
Well, Tamanna, everyone got that one for the longest time. It was hovering around those 1400 levels for a long time, and everyone thought, it's a done and dusted kind of a trade. Perhaps, no one wanted to touch at least the fresh allocations with the bar spool also. So I think even now, if you look at, from the target perspective and just the regaining of the lost ground, even then, I think there is, this is a good entry point. But, considering that it's run up just in the recent past, I think 1475, 1480 would be a good zone to perhaps consider it, at least from a trading perspective. From an investment perspective, it's a good idea to start accumulating here if you haven't done it already.
Kush has that I told you so smile this morning when he's talking about HDFC Bank. But we're going to give you an opportunity to have more of those moments by asking you, what are your picks for the day?
Well, Tamanna, on a lighter note, I did tell you so.
Yeah, that's why I can recognize that smile. So what are your picks for the day?
A couple of them, both of them incidentally from the cash segment. One of them is Spark, Sun Pharma Advanced Research. The stock shown phenomenal recovery, close to completing what we call a rounding bottom formation. I know the stock was locked in upper circuit yesterday, perhaps, could be the case today also, but even thereafter, we have a target of 430 and 450 on Sun Pharma Advanced Research. 395 is where I would place my stop loss. The other stock which is attempting a revival has shown a fair degree of it already is HBL Power. Big move day before yesterday, some consolidation with a positive bias yesterday. So HBL Power is also a buy for us. 530, 555 are the near-term targets. 475 is where I would place my stop loss.
Okay, just to highlight both of those calls because remember, Spark is still a well-known, well-entrenched, and HBL Power 2 is well-known, of course, but just the cash market trades. So Spark, the target is 430. Remember, had a big move. Don't quite know what happens today, but had a big move yesterday. And HBL Power is the other one, and the target price is at 555. Watch out for that one, 496 and counting. Okay, so we've discussed financials, we've discussed some stock ideas. Let's discuss the bad news as well. And Sunny, want to come to you on consumption because Dabur's numbers and the commentary yesterday left a bit to be desired. Today we're seeing some notes from one of your peers and cities saying that on consumption items like maybe a Bata, maybe a Page Industries, the competitive intensity would lead to much lower earnings than otherwise estimated. What's your sense on consumption stocks from here on for the next 1 month? Would you, if you had them in your portfolio, would you swap them for better ideas? And which ones are you negative on if you are negative on?
So yeah, Niraj, I think the within the consumption sector, staple is a sector, a subsector which is likely to deliver a kind of mid-single digit or a high single digit kind of growth, and that's the commentary that was from the HUL also during the December quarter. And as we see that Dabur provisional number, it seems that is panning out to be on the similar trajectory, low single digit to kind of high single digit kind of growth. And all these companies trading at north of 50x price to earning multiple. I think So I would like to stay away from consumer staple at a current juncture and better bet my money basically on the two theme from a short-term perspective, 1 or 2 months. So one is the summer portfolio. So recently we have recommended some stocks in the summer portfolio to our client. If you want to ride on a short-term move, so companies like Blue Star, V-Guard, Wonderla. So these are the few companies, or power companies for that matter, Tata Power. So these are the few companies which one can add as far as consumption sector is concerned. And in addition to that, consumer discretionary is the sector which wherein I feel the numbers continue to be robust. So Kalyan Jeweler has reported a very robust set of provisional update. I think 34% consolidated revenue growth for fourth quarter, and India operations growing at 38%. So I think it's a clear-cut K-shaped recovery which we are seeing in the economy, and the consumer discretionary is the place to be in if somebody wants to be in the consumption space.
Certainly, watch out for some of these consumption names, and Kalyan in particular on the other side, on the right side, because I think they've delivered. The provisional update seems to be very strong. Kalyan, Macrotech, Puravankara, it seems to be a day when you're releasing provisional numbers, then they're turning out to be good thus far. We take a break. Of course, the RBI policy stated for 10 a.m. and then the post-policy conversation with a clutch of experts. So do keep an eye out for those as well. But we'll be back from a break in just moments from now and try and take forward the trade conversation. Back with India Market Open right here on NDTV Profit. Pull up the implied open to just give you a sense of what is it that we are likely to do today. A bit of red for sure. Whether it stays here or does it extend itself remains to be seen. Remember, we are still vulnerable to higher crude prices. Maybe not as vulnerable as we used to be 10 years ago or maybe 15 years ago, but we're still vulnerable. And sentiment-wise, a higher crude price would bring about some bit of an impact. That the global markets are also weak only adds to the stress. So we'll have a down day today, or at least the start, which will be weak today for sure.
Fundamentally, I just wanted to point out, maybe sentimentally for the market, $90 doesn't spook you as much. But fundamentally, India is still as vulnerable to higher crude prices than we always were. Yeah. We want to move the needle, but that's a plan in the future. As of today, 90-95. No,
relative to 10 years ago, much better off. Forex reserves, the alternate fuels,
we can afford it. We can afford it, but it still costs us more.
Most certainly.
So that then is not a very great thing. All right, let's see your pre-open rates. We'll give it a couple of minutes to settle down. Not very clear cues right now, but remember, we were set for a negative day. All of Asia has had a tough morning. Nikkei was down 900 points at one point, but remember, in India we have been bucking the trend in a way as well. Just HDFC Bank in the first few seconds, and if you could look at what's happening there, 3.5% once again in the pre-open rates. Shriram Finance doing very well. It's a day for the financials. ICICI Bank about 1.5% odd. Banks and IT has been the theme, and Wipro is not doing too badly this morning as well. Of course, we'll wait for that to settle down. I want to look at what BAF is doing, what is Bajaj Finance, Bajaj Finserv doing this morning, because we've been talking about that as well. Not too much of an action right now, but again, we'll wait for some of those rates to settle. Let me go back to Kush Bora and Sunny Agarwal. Kush, you spoke about HDFC Bank. What about Bajaj Finance? Some very lofty target prices have been floating around this morning from several brokerages. What would be your own sort of number?
So, Tamanna, I'm a little divided here, purely for the fact that, this, of course, has been the darling for the markets for a very long time. But then there has been that brief period where it was beaten down. The revival has been very sharp, and that actually is a cause of a concern for me. Had this been a more gradual, steady kind of a revival, perhaps, the conviction on this rally would have been higher. But this has been a very sharp, vertical kind of an up move. And if you see it's hovering around the 200-day moving average now, I mean, just above that. But if I draw a trend line, it's still below that. And that level comes in at about 7,400 or a little higher, but to round it off, 7,400. So for me, any kind of positional conviction that comes on this will be when it crosses and sustains 7,400. Then perhaps, we're looking at, 7,750 as the first target, and then perhaps even 8,000. But up until then, I will be a little skeptical. I will be a little watchful. And purely because in the past, we've seen such big moves where the stocks actually risen anywhere from, 15 to 20% and then given way. So while this is, an encouraging move for existing investors, I will hold back my, buying spree till the level of 7,400 is taken out.
Absolutely. So Bajaj Finance, you're a bit divided on. Sunny, I want to understand whether you're as enthused about the AUM growth figures as analysts seem to be, as far as Bajaj Finance is concerned. I think you're on mute, Sunny.
Yeah, sorry for that. So basically, I think the numbers continue to be robust. So I think 30% plus kind of growth, which we have seen on the Bajaj Finance. So the only concern right now is because of the restriction by RBI on basically cards loans. So we have seen some decline in the new loan origination number. But having said that, I think I would like to maintain a neutral view as far as Bajaj Finance is concerned, because healthy growth is backed by the very expensive valuation also. Right now, I would like to maintain a neutral view as far as Bajaj Finance is concerned.
Okay. Well, that's on financials, and let's I think in about 3-4 minutes we'll get the final rates as well. Sobha left a bit to be desired. So real estate today has a chalk and cheese kind of a performance. I would reckon that Sobha has done this only because of the spillover, but Macro Tech and Puravankara, very strong numbers out there from both. Now, Sunny Agarwal, when you look at these Q4 updates, wherein Puravankara does a 90%, but it might be an aberration and a spillover from the previous quarter, but a Macro Tech also delivers those numbers. Sobha, the pre-sales at 1,500 crores is flat, but maybe the next quarter sees some upticks. Are you still constructive on real estate, or now are you booking profits there?
No, again, Niraj, so we have been seeing a very strong set of numbers from all the real estate companies since last 3 to 4 quarters. And I think the momentum has continued, seems to be continuing in the March quarter also. But having said that, what I feel is that now one need to be a stock picker as far as real estate stock is concerned, because we have seen a massive up move also in the entire real estate basket. So I would like to go ahead with the companies where the balance sheet strength is very robust. So companies like Oberoi Realty, or for that matter, Phoenix Mills, where it is the portfolio is skewed towards the commercial rental, as well as it's a story on urban consumption. At the same time, companies like Century Textile, which is backed by the Birla Group, venturing into the a new territory. So these are the few companies where I would like to bet my money rather than betting on the every stock in the real estate basket.
Okay. Fair call. Stock pickers market, real estate, after the rising tide has lifted all the boats. Be very specific is what Sunny is saying. We'll talk to Kush about some of these as well, but it's 9:05. So usually the time when we get you some key brokerage notes for the morning. Bajaj Finance and Dabur are in focus. Harsh, tell us, what are you gleaning?
Well, yes, Jeffrey is on Bajaj Finance, extremely positive, 9,400 being the target price. It's a it's their top pick in the NBFC space, and what they are suggesting is that loan growth continues to be extremely robust for Bajaj Finance. Pre-quarter update shows that growth in customer base also remains healthy, is what they are suggesting. Now, interesting piece from the City note that I read with regard to Bajaj Finance itself. What they are suggesting is bank borrowing has gotten expensive for Bajaj Finance, and therefore you might see a around 10 basis point decrease on the margin count. But outside of that, the update is very strong. They're expecting 4.3% on the ROA front, to more than 20% on the ROE front. And they believe that remedial measures with regard to RBI curbs put will be something that will be monitored by the street as well. But outside of that, they are also quite bullish on Bajaj Finance, nearly a 9,000 rupee target price even by Citi. So that's one interesting note which came through. The other one was, with regard to Dabur. Citi reiterates a sell on Dabur. Target price has been revised downwards to 500 from 520. They believe that the Q4 update is pointing to a weaker set of numbers than expected. Profitability below estimates expected. EBITDA also below estimates. Margins also below estimates expected. They believe that inferior category mix is what is possibly impacting at least the margin number as well as the overall Q4 numbers. Business has increased, but volumes remain soft, and that is something that they are concerned about. They've obviously maintained their sell rating. Target price 500 revised from 520.
Okay. Well, Dabur is interesting. Bajaj Finance is interesting. And I dare say I'll watch out for, as the pre-open rates are settling down, want to see if there is any kind of negative reaction to those Citi notes on Page Industries and Bata, because those are the other two that looked interesting, because they've come out and opened a negative catalyst watch on both Page Industries with a target price of 31,000 and on Bata with a target price of 1,000. Now that's a substantial downtick from the current market price for a Bata as well. So pretty interesting to see how it goes here. But Kush, a technical view though on some of these consumption names. Harsh was talking about the brokerage view on Dabur. Sunny spoke about his thoughts. The stock was down 4.5% yesterday. Can it slide further?
In all likelihood, Niraj, because the support zone is at around those 505 levels. It's actually tried a couple of times to rebound from there. And in technicals, what we often see is that if the stock is knocking at the doors of a particular level, either on the upside or the down, then it eventually does break it. So there is a possibility, that we could be looking at even 480 kind of levels positionally, on Dabur. Hasn't really done much in the last few years, if I can, say that. So I think positionally, 480 is perhaps, a more convincing level. 505 is a near-term, support zone, but I think that should perhaps be, taken out.
Yeah. Let's come to some of those real estate names also that Niraj was talking about. Sobha, not great updates, but Prestige on the other side has announced the acquisition of a property in Whitefield. Pre-market, that stock is about 3% up. Puravankara, Macrotech, all of them have had, on the face of it, good business updates. Puravankara up 5% pre-market as well. Macrotech not looking too bad. Sunny, anything that you would, start fresh buys in?
So basically, you are recommending referring to only real estate sector or entire market?
Real estate.
Yeah, so within real estate, as discussed, so again, my topic there will be Century Textile, although provisional updates are not there. I feel that is a company that is likely to do well over the period of next 2 to 3 years. At the same time, I would like to bet my money on Phoenix Mill, which is a play on urban consumption story. So there we are seeing a very rapid expansion as far as new area is concerned. So Phoenix Mill is one of the pick which I would like to ride through discretionary consumption. And one stock pick which is again a Mumbai-based real estate player, that is Nesco, which is again a play on basically MICE event, wherein we are seeing a lot of uptick in the exhibitions which have happened over the period of last 3 to 4 quarters. So I think Nesco is one of my pick as far as the real estate sector.
Kush, any views or comments on any of these names that we've talked about? Especially Puravankara seems to be doing pretty well, and let's see how it opens though. But what would be your play on this counter and others in the space?
So just on Puravankara, I mean, the stock's staging, a neat rebound. So there is a possibility that, this momentum, could well continue. The two stocks that I like from this space, one of them is Prestige. There was a brief, period where the stock dipped, but the recovery has been equally sharp and equally encouraging. So Prestige for sure. And one rather lesser discussed stock, which I think I've mentioned, once or twice on your show as well, which is Shriram Properties. This stock too, has pretty solid structure. The recovery here too has been very smart. Relatively smaller ticket size. So I think from a near-term perspective, 140 is a very convincing level, and beyond that also I'll continue to hold. So Prestige and Shriram Properties are the two stocks that I have on my radar.
All right, Prestige and Shriram Properties. But the other space, that I wanted to see how it's doing. And Sunny, what would you reckon in terms of any impact you'd see? Crude at 90, we've been talking about how much it matters in a sense to India as an economy. But in terms of stock specifics, you had a bit of a hit on ONGC, IOC, all of those counters, the HPCLs, BPCLs of the world were also, reeling yesterday. Would you have a call today at all?
So yeah, definitely, Tamanna. So I would like to avoid all the oil marketing companies, and the reason being very simple, that with the crude oil trading at $90, and with the we all know that for the next 2 months there is no very less likelihood of in fact 100% chance that there is no change in the retail fuel prices. So I think the marketing margins for all these companies will come under pressure. And at the same time, we have seen a big downtick as far as Singapore GRM is concerned. So I think both the division will come under pressure as far as June quarter is concerned for oil marketing companies. And positive for upstream companies like ONGC and Oil India. At the same time, what I feel is that high crude oil prices will have impact on FMCG, because we all know that palm oil prices are also trading at a multi-year high. So FMCG companies like HUL, Dabur, there we may see some increase in throughput cost, and that can hence there also we can see some margin pressure. Cement companies, although slightly cushioned because of the no change in basically retail fuel prices for next 2 months. But whenever once the elections are over, we may see in case the crude oil price sustain at $90, then we may see some sharp uptick as far as retail fuel prices are concerned. And to that extent, we may see some pressure as far as cement companies' margins are concerned.
Kush, very quick call on Hero. Hero Motor down about 1% in pre-open. Not sure if there's any clear trigger, but there was a tax notice of about 600 odd crore rupees, which was reported yesterday. Do you like it on the charts at all, or what would you recommend?
No, I'd wait for the level of 44.40, a strong support zone there. If that gets taken out, then it could slide further. So definitely a wait and watch on this one.
Okay. Kush, we have maybe 30 seconds. If I had to press you for one top call now that the pre-open rates have settled.
Spark, Sun Pharma Advanced Research.
Okay, so let's pull up Sun Pharma Advanced Research if we can here. Okay, we have it on the screen. 1.45% higher. That's Kush Bora's top call. I think the target price was, this uptick today takes it a few points closer to the target price of 430, was it? Maybe we'll check with him post the market start about whether it's good to buy even now. Not bad. Let's wait and watch how it shapes up. But here's how the markets are starting off this morning. It's a Friday. It's the RBI policy day. And ahead of that, the global cues aren't exactly the strongest. Indian markets, though, a lot better. Well, maybe not around those points only. 60, 65 points, we were indicating about 72 odd points. So in or around those, the banks maybe a bit better behaved, but largely in line. I would reckon most sectors would be following those cues. Individual names could be doing well. Small caps have recently been outperforming for the month of April. Thus far, too, doing okay. Flattish start versus about 1/3% for the index. Get the heat map up on the screen. We'll also take a check at the market breadth a bit later on. But a lot of red, which points to maybe not too many stocks correcting. In Bajaj Finance case, it may well be the customer addition number, which was a disappointment, leading to this downtick. BPCL, we all know the reason why. Hero MotoCorp is down. Tamanna was talking about that notice. Maybe that is impacting. There's a little bit of corrective move that is coming in L&T, Hindalco, and Eicher. So two-wheeler companies are certainly under a bit of pain in session today. Hero, Bajaj and Eicher, all three are down in trade. Wonder if TVS also might be down. We'll check that a bit later. Nestle is up in the green. Well, I don't know if it's the 8-year-old case getting quashed, leading to this uptick for Maggi, but Nestle is up in the green. Shriram Finance marginal in the green. NTPC and HDFC Bank, after having 2 strong days, starts off in the positive yet again. Reliance is in the green as well. Upstream oil likely should do well. ONGC, the top loser yesterday, is flattish and marginally in the green. So that's the other piece to monitor. So keep in mind all of these. But two-wheeler stocks, Tamanna, certainly seem to be down in trade today. Oil marketing companies seem to be down in trade today. And Bajaj Finance, from the larger boys, the one which has given out the update, is sulking a bit.
Yeah, that's interesting because so much of cheer for Bajaj Finance's updates, but yeah, completely. A closer look is warranted on it, and maybe two-wheeler seeing an overhang of consistently high interest rates is starting to impact. Nevertheless, as tepid as this may seem, there are a lot of stars this morning as well. I want to pull up Aavas Financiers, IndusInd Bank, Bandhan and ESAF Small Finance Bank. So this is all about the business updates. Aavas is doing well, 4.5% up. IndusInd Bank, again, seemed like good business updates and a lot of cheer over there, but the street seems indifferent, so to speak. Let's see what Bandhan is doing, and as well as ESAF Small Finance Bank. ESAF Small Finance Bank is okay, just about 1.5%. 2% up. Bandhan not so great this morning. Again, business updates for some of the realty stocks that we've been discussing all morning. So Macrotech, Puravankara are the ones which Puravankara definitely great numbers, 90% plus on sales, etc. for the year. Macrotech also decent, 40% plus numbers on pre-sales, but stock about 1% up. I reckon there is selling pressure in the market today, and that nervousness is being seen, which we can also see globally and ahead perhaps of the monetary policy. Voltas is another one that we should quickly look and see what's happening. HSBC maintained a buy for 1350. So yeah, the stock is pretty bullish. Of course, the hot summer that we're all expecting, the heat wave, may help a counter like Voltas as well. So these are few of those which are responding this morning. But overall, Niraj, I think there is a sense of nervousness, isn't it?
Yeah, a bit of that for sure. But certainly some stocks deserve mention before we get back to our guests. So Tamanna's marked Prestige, I'm sure, but that's really, for my mind, at one of, including Mahindra Life, a stock which is standing out. And the shipyard stocks, Cochin Shipyard is up 3% yet again. So very strong show by that one. Yeah, Mazagon Dock is up about a couple of percentage points too. I don't know if it's got the defense element to it or otherwise, but clearly, those stocks the last few days have actually done very well for themselves and continue to do well. So that's the other point. I wonder if ESAB Small Finance Bank and Rashi Peripherals bring up those two stocks. ESAB not too much, 1.52% higher, so nothing too great. Rashi Peripherals, 5% upper circuit. Not surprising there. Angel One continues to sulk though, and Soba sulks as well. HPCL, BPCL continuing to be under pressure. Okay. Sunny, Kush first, opening thoughts to you. Also an update, you'd still go out and buy that Spark call?
Oh, absolutely. Fairly, even if there was, a slight dip and, it opened, in the red, I would perhaps, still go out and buy. 430 and 450 are the targets, and, we do maintain those.
Absolutely. So Spark still remains there. Sunny, just to get a sense of what you are spotting and what you're finding interesting today as well, I thought that Nestle run-up was, one to note. Not too much of an impact. It is an 8-year-old case and finally dismissed. But do you see a further upside in a Nestle, a Dabur as well?
No, Tamanna. So I would like to stay away from, consumer staple. If I have to bet on one company, I think that will be Tata Consumer. because again there we are seeing both organic as well as inorganic growth opportunity. So that's the one company which I would like to bet my money on in the consumer staple segment. Now, one company which I'm finding very interesting is Mahindra and Mahindra. So after a long time, we have seen stock price crossing 2000 levels yesterday. And again, backed by the very robust order book. So standalone business, especially passenger vehicle SUV portfolio, continue to do well. Tractor business, which was under pressure during FY24, is likely to do well on the expectation of good monsoon, upcoming monsoon. So I think both the cylinders will fire for Mahindra and Mahindra. And I feel on valuation front also trading at a relatively cheaper valuation. So I feel the fair value of the business is close to 2,300 rupees. So if somebody want to bet money for 3 to 6 months, I think Mahindra and Mahindra is a place to be.
Okay, Mahindra and Mahindra is looking good. IT stocks under pressure today, turning after 2 good days of gains. Nifty IT down about a percentage point on open. And let's just pull up the internals to see what's happening there and where the most pain is really coming. But, IT is definitely one space. So as an Angel One, their client addition numbers were disappointing. And that's why you saw an Angel One crack towards end of trade yesterday as well. On all of these set of counters, Sunny, and I'll come to you on this, whether it's an Angel One, whether it's a CAM, whether it's a BSC, they've had their great run. Do you see something sustaining there?
Tamanna, I think the entire capital market as a story is still very young. And if somebody take a slightly longer horizon, 3 to 5 years, I think there is a long runway of growth for this entire capital market stories, whether it is wealth managers, brokers, exchanges, or RTAs. I think from 4 crore demat account in 2020, now we are at close to 14-15 crore. And I think this number is growing every month. At the same time, on mutual fund front, we are seeing a record high SIP inflow, AUM crossing 50 lakh crore number. So I think the entire this capital market story is still young, and we may see some volatility in between short-term up move or downtick due to some short-term data. But one has to take a slightly longer view over here. And I think one should remain invested in all these names from a long-term perspective.
Just your take, Kush, on an Angel One?
Well, there was promise in this rally, but I think, the kind of move that we're seeing today will perhaps, bring it into that consolidation zone. But I don't see too much of a negative here. Any dip towards those 28, 50 kind of levels might just turn out to be a buying opportunity. So on the whole, constructive. But this could well just be the profit booking after the news that's just come out. So 2850 is an accumulation zone for me on Angel One.
Okay. Sunny, the last few days we've seen a few notes come out on chemicals. This morning I've seen an HDFC note on CDMO players. I've seen a Spark Capital note which speaks about how some of the things might be turning around the corner as well. I'm trying to think, have you guys done some work on whether specific buckets of chemicals could fundamentally be strong to buy?
Again, Niraj, what I feel is that chemical as a sector, I feel it's still a quarter or two away where we may see a commentary turning positive. So due to some global events, some subsector of the chemical prices may shoot up, and to that extent, we may see a short-term reaction in the chemical company. But if somebody want to create a sustainable value in a chemical as a sector, so I feel the companies where we have seen recent completion of the capex, so companies like, example, Deepak Fertilizer. So there we have seen an ammonia plant basically getting commissioned, and in case the monsoon is normal during the June to September quarter, so we may see a normalization in the entire chemical basket, and Deepak Fertilizer can be a good bet on agrochemical as a space. Similarly, PI industry continue to do well despite of the concern that China is dumping. So I think these are the few names where one can ride on chemical. Overall, chemical as a basket, I still feel it's a 2 quarter away story where we may see a conviction as far as earning upgrades are concerned.
All right, just to look at what metal stocks are doing this morning, and you're seeing some pressure there on a Hindalco as well as JSW Steel, Hindustan Copper, In fact, the Nifty metal also lagging. And yes, that's one commodity cycle which is showing quite a bit of volatility. Sunny, what would you do with the Hindalco right now?
Again, I would clearly track the metal prices, and right now we have seen a big bump up in copper as well as aluminium price during the last 1 month. So I would like to, I would be bullish on Hindalco as well as Nalco among the aluminium space. Yeah.
Okay, gentlemen, both of you, thanks so much for taking the time out and being with us. Time to slip into a short break, but stay tuned. We have the management of Anupam Rasayan, since we are talking about chemicals and chemistry. That's coming up on the other side on the latest order win, and then a conversation with Pankaj Murarka on the market reaction to policy. Well, chemical companies are in a bit of a buoyant momentum, if you will, because of various factors. In some cases, there are shortages. Some cases, there are duties that are there. In some cases, they have won some orders, signed LOIs, and then therefore, it's important to, of course, dissect each on their own, which is what we are trying to do today with Anupam Rasayan. They've recently signed an LOI with a Japanese multinational company. The aggregate LOI value is about $90 million over 7 years, but it's after a while that we're seeing some of the chemical companies starting to maybe get these orders as well. Is this indicative of things turning at the margin? Let's pose that question and talk about more than this, of course, with Mr. Gopal Agrawal. He's CEO of Anupam Rasayan, and Mr. Vishal Thakkar is Deputy CFO of the company. Gentlemen, thanks so much for taking the time out. Let's start off with the news first. Let's talk about this LOI with this MNC company. What is this about? Where does this fit into the scheme of things for Anupam over the medium term? And is this the first of many such things that you would be doing in calendar year 24?
Okay, so if I were to just give a little background to that, and then probably it can be expanded further, that this is an effort. This is a result of the effort that we have been putting in for last 6 to 7 years. Japan is a geography that we have been focusing very actively, and in last 18 months, if you see, we have built up a large team, a significant presence in terms of team and presence there. And again, with Mr. Gopal, our CEO, really, spending a lot of time traveling to Japan and building this franchise is really helped us in terms of, culminating this LOI. And yes, there are a lot of buoyancies there, and we believe that this is a good start of a journey of Anupam in Japan.
Mr. Agarwal, you want to add to that? It's cherry blossom season and certainly blossoming for you. So talk to us a bit about this particular order and what it would mean for Anupam. I reckon that the supplies commence from the current financial year.
Yeah, so I think just to add to what Vishal said, and maybe I'll take a kind of a bit of a step back. See, as a company, you could look at, probably trying to kind of solve for short term or long term. I think the approach which Anupam has always taken is look at a little long-term horizon. It is a bit of a painful journey, to start with, but then eventually kind of it pays for. So as you rightly said, for some of us, this journey in Japan kind of started almost, I would say, that we have been in Japan for almost 10, 12 years. But some of these products, especially on the fluoro side, which we have kind of, signed the LOI for, we began, some of this exercise with our customers almost 5 to 6 years before. And what we are trying to do here is basically not look at again a short term. We are basically looking at getting some of these products which are manufactured in those geography or by our customers to India, which would mean that we are looking at a kind of a long term, let's say, solution for our customers. It is a complete kind of a supply chain solution which we are providing to them, and which is where from a long term perspective, we are able to kind of sign some of this contract. Which will give us a, let's say, revenue visibility for next 5 to 7 years. This is just one of the LOI which we have, let's say, kind of signed with Japan. I think, if I kind of talk about in last 2 years, we would have done roughly maybe 4 to 5 such LOI with Japanese customer. And for us, while, Europe, used to kind of contribute significantly to our revenue. But yeah, I would say last 4-5 years, we've been trying to kind of build on to Japan and US, which are, I would say, a little tougher market. But yeah, we do believe the maximum amount of growth, at least for us, is going to now come from these geographies. And hence, I think some of the effort which we have put over a period of time are yielding results.
So Mr. Agarwal, is this a belief or hope that because of this, more contracts would come your way, or are you already in conversations with other players as well for whether an LOI of this nature or otherwise, but doing some stuff like this?
So you are right. I think, we are kind of talking to, I would say, multiple customers, both in Japan and in the US. And, the way we are kind of going about it, is that, see, there are certain strengths, which we bring in certain chemistry and certain processes. And our idea is to basically look at augmenting that, for us, and, those to be our growth catalyst. And what I mean by that is that there are certain chemistries, where we have, let's say, a much better understanding than some of our peers. There are certain products where we have a complete solution, let's say, starting with the base material and, going up to, let's say, almost the finished product, which we can supply to our customers. Which means that, when it comes to quality, when it comes to cost of production, when it comes to managing, let's say, the supply over a period of time, we are at least among, let's say, ahead of others. And that is something which obviously is giving us that edge, wherein, we are able to kind of win some of these LOI. Of course, the benefit of this, one would see over next 5 to 7 years. So, yeah, from a long-term perspective, I think we do believe, I think the effort which we have put in, there's a lot, and enough and more which is going for us going ahead.
Okay. Vishal, just one quick follow-up here. I mean, fluorination per se is a difficult chemistry. So 2 questions rolled into one. If I'm not wrong, this is on the pharma side. Until FY23, this was about 3%. So does this increase that presence? And 2, does it happen at the similar operational metrics or better operational metrics than your average numbers that you enjoy at Anupam?
So yeah, you're right. The pharma, fluorination has been a very interesting chemistry in that sense, and there are limited number of players who do this. For us, this has been a chemistry for last 6 to 7 years. Even today, 15% of my revenue would come from that chemistry included into my portfolio. Coming to the margins, see, we are a CDMO player. We have a very, very focused way of doing business with our customers, where we look for a particular level of returns on our investments and margins, and that's typically we have been in the range of 26 to 28%. I think we would try and focus on that numbers. Depending upon the product to product, there may be a bit of a variability, but yes, this is where we would like to be. We would like to be in the margins which are more stable, more sustainable, where my customer is able to afford and I am able to make money out of that investment is the kind of a numbers that we will look for. No doubt, fluorination has its own advantages, and you get upward tick on the margin, but that's where we will want to be positioning ourselves.
So, and sorry, just getting a clarity, does this fall within the business verticals that are existing like agro or pharma? This is a pharma thing for you? No.
So this is more into the engineering fluid side, and bit of it will go into pharma as well. But yes, it will be a combination of both the things. So it has application across multiple usages.
Okay. I'll end this interview with a question on CDMO per se, because a bit of a hibernation out there again, or because of funding winter, if you will. So many reports spoke about it. I'd love to understand that. But just one quick word on this fluorination, because you not recently, maybe 2 years ago, acquired this stake in Tanfac as well. Is all of that leading up to this confidence of bagging more orders in Japan and US over the course of the next year or two?
No, so you're right. Maybe Vishal, I'll take a dig at that and then you can add. So you're right. I think as far as some of the, let's say, final product, we have been working with our customers, I would say fairly for a long period of time. But yes, as you rightly said, acquisition of Tanfac basically gave, I would say, leg to, the whole fluorination, supply chain from our perspective. As I said, most of our customers, are where either we are the only supplier or among the, let's say, the one or two primary suppliers to them. And what people, let's say, in some of these developed market, whether Japan or US are looking at is that, am I able to, provide him a complete supply chain solution? And that is exactly where, this Tanfac acquisition really act as anchor, wherein we are now, controlling a complete, what you call supply chain, from that perspective, where we are able to get that assurance to our customer that we are in a way not dependent on anybody else for us to fulfill those requirements. So this has definitely acted as I would say as a huge catalyst in our fluorination journey.
Okay, fair call. One question on numbers, and then I know you're in a silent period, so I won't ask you guys about too much, but I'm just trying to think of this. While your revenues may have fluctuated, you maintained your margins. I heard you say that these new products are also coming at least at those margins, and correct me if I'm wrong here. Suffice to say that if indeed business picks up over the course of the next 12 to 18 months or 24 months, then because you've managed to maintain your operational metrics any which ways in this, then the pace of growth on the profitability could be fairly brisk if I take a 2-year view from here on.
See, I'll take a dig. I'll give you a bit of a perspective on that. If you look at it, my margins are not where I'm talking at the gross levels. Typically, my margins are at the EBITDA levels. So what I agree with my customer is at the EBITDA levels, because my overheads are also passed through. And so that's the reason if you see my percentage margins will continue to be the similar range, depending upon the product profile, depending upon the contribution of the different segments, it can have it. But for a particular product, my margins will remain sustained, depending upon the volume going up or down. So the question is that if I have a higher growth, will I have a higher margin percentage? May not be. Absolute number, yes, definitely.
Okay. And last question. Almost everybody, I speak to any company on the pharma side or otherwise which are engaged in CDMO, they've spoken about, or analysts, and they've all spoken about how there was or probably still exists a funding winter in CDMO operations, and at some point of time in the next couple of quarters this will change. Do you get a sense like that as well? And could we therefore see enhanced order flows for everybody on the chemical or the pharma side but engaged in CDMO?
Maybe I can go first there. I would just say, I think, to answer it more like generically, it will be a difficult one. It will depend, in terms of what chemistries or, what APIs you are in. So if I was to kind of answer it, it is, one thing is for sure, gone are the days where you could just basically look at importing and, doing probably, let's say, one or two process and, imagine that you would be able to sustain on a long term. So people who have, kind of developed, I would say, X amount of backward integration or, some of the product where they have Y amount of niche are the ones who will definitely flourish. And to that extent, I don't think so, funding winter would ever be a problem for those guys. So what I would say is that, what people saw in last 2 years or 3 years where, in general, everybody kind of benefited and there are multiple reasons, including COVID. Where certain geographies were not able to produce, definitely will not be the situation going forward. So you will have to have a certain amount of niche, either on the product side or on the technology side, for you to kind of really be able to attract that kind of a capital. Vishal?
I think that's where it is, that there is enough and more demand. It's only that can you deliver it in a holistic manner where you're able to give supply chain solution completely through technology. That's where I would say.
Okay. Gentlemen, congrats on all of this that you're doing. All the best with everything that you're trying to do. We look forward to continue talking to you post your quarterly numbers and otherwise on important milestones to try and assess what your shareholders can glean from the developments and the events that happen in Anupam Rasayan. Thank you so much for talking to us today.
Thank you. Thank you very much.
And viewers, thanks for tuning into this conversation.
right, less than about 12 minutes to go before we hear Governor Das on what will be the first monetary policy announcement of this financial year. Are we going to see new guidance set or new estimates set for growth, for inflation? Not much of a chance, actually very, very minimal chance of any kind of a rate cut, but the street will be watching in commentary on what could be expected in terms of a timeline. Meanwhile, a quick look at what the markets are doing, and completely tepid, maybe in wait and watch mode in anticipation of what happens in the next 15 minutes to 30 minutes or so till you have clarity as far as the governor is concerned. What is working this morning, and maybe a bit of a surprise, is Pharma. Pharma has sprung to life, whether it's a DRL up to 2.5%, Sun Pharma, Cipla, all of them up in the green, pushing up that index as well. DBS Lab having another good day. But meanwhile, let's go across to Pankaj Murarka. He's CIO of Renaissance Investment Managers, to get his sense of what the market is expecting, if much at all, from the governor. Pankaj, very good morning to you. At a time when global cues, at least overnight, have been dismal and crude has become a worrying headline once again, do you think that there's going to be much movement or much anticipation from what Governor Das says?
Morning, Tamanna. No, not really much. I think the fact is it's a pretty, consensus view. I would expect that the RBI will have a pause and unlikely to act. Probably our view is that any rate cuts in India is only a second half phenomena. So we don't, because bear in mind that last year we had a poor monsoon, and that led to a spike in food inflation over the last 1 year. It's only now that the food inflation is moderated. So I am of the view that RBI would want to watch out for how monsoon pans out this year before they take any rate cut decisions. So I think rate cuts are not in the offing, at least in the first half of the year. And I don't think so that has an impact on the economy. The fact is that the Indian economy has been very resilient. If you look at last 1 year, where we have significant slowdown, especially in European markets, and exports have slowed down, yet we've had strong growth in the economy. So I think the growth outlook for economy remains very strong. And in view of that, I don't think so. I think RBI policy will be a no surprise kind of an event.
What would you be looking out for, Pankaj, in terms of commentary from the governor, especially in light of, like I said, Brent at 1991, concerns over there? Will we see inflation come back as a worry, and perhaps a reiteration that you want to stay on target as with an withdrawal of accommodating stance?
Well, liquidity in the system has already been tight. So in a way, there has already been a fair bit of withdrawal of accommodation, COVID-induced accommodation which RBI had done has already happened to a great extent. Yes, the short-term food prices have had a spike, though directionally or from if you ask me from a 1 year perspective, we continue to remain negative on crude because we think there are significant headwinds to global demand and global growth. Having said that, this geopolitical news flows has had an impact, and we've seen crude has actually moved up by about $10 if you see in the last 6 weeks or so. But we still think that, meaning our view, if you ask me my view, I think all that we are seeing globally in terms of statements coming from all across Middle East and US, I think there is more of rhetoric in this, and our base case is we don't see any of this Middle East issues escalating in any manner. So we think probably the spike is a temporary spike, and crude should cool off again as we head into summers. So while it can have a temporary spike, we don't see it having a significant impact. Though having said that, given the fact that we just had a cut in retail fuel prices in India a few weeks back, probably once we are through the election, there will be some increase in retail fuel prices. But I still think that overall inflation picture in India is very much manageable.
Pankaj, good morning. Niraj here. What you're effectively saying is that the RBI decision becomes a bit of a non-event from a market's perspective. Not just now,
yes,
even for the next two policies.
Yeah, I would think so. Meaning the only thing, in fact, I would add is that I would not want RBI to probably go ahead and do a rate hike in a hurry. Because there are still, while inflation is within the band, but still there are underlying inflation pressures. As we are discussing, let's say there's been a short-term spike in crude prices, commodity prices are elevated. So I would, and the fact is that even at the current rate of interest, the economy is fairly strong and fairly resilient in terms of the growth numbers we are seeing. So I think RBI I would expect the Reserve Bank not to hurry themselves into a rate cut, because in that case we end up getting into a situation where we can create a bigger macroeconomic imbalance going forward into the future. And we certainly want to avoid that, because it's a very hard-earned macroeconomic stability that India has earned now post-COVID. There's a lot of effort that has gone into it, and there's a lot of fiscal and pain that has happened in that sense. So you certainly don't want to disturb that, and RBI has been time and again reiterating that their major focus remains macroeconomic stability.
Got it. Pankaj, now from a market's perspective, the two actually real estate may not be as much interest rate linked, but be that as it may, just for the sake of what's always been spoken about as policy sensitive or rate sensitive, banks, real estate, autos, the three are on a trajectory of their own. In autos, two-wheelers maybe more so, but certainly real estate and certainly financials as the Q4 updates are seen. So would you reckon that a no rate cut scenario for 2024 could still mean that there could be buying opportunities into these pockets because of what they are doing fundamentally?
Yes, I would agree with that, though I still think there will be rate cuts in the second half of this year. I think one on rate cuts, I think India and world, what we'll see in this rate cut cycle is India and the world will witness a shallow rate cut cycle. There are no steep rate cuts that are around the corner in this cycle, either globally or in US or in India, because the underlying inflationary pressures still are pretty resilient in that sense across the world, including India. So I still believe in the camp that there will be a few rate cuts probably in the second half of the year. But having said that, I would still think so what you said, that these sectors will do well, because the fact is that underlying demand momentum in all of these sectors remain pretty strong. Two-wheelers has been a laggard in that sense in the post-COVID recovery, but there also we've seen now rural sales and two-wheeler sales coming back. If you look at real estate, meaning year after year, last 4 years, each of the years, including the last financial year, the top 7 metro markets in India have had the highest lifetime sales. And still, inventories which were piled up, if you look at inventory to sales ratio in some of the key markets like Bombay, Delhi, they're the lowest ever that we've seen in the last 15 years. So which effectively tells you that underlying demand in real estate continues to be strong. Job creation in the economy is very robust. So I think the real estate sector will continue to do well. And likewise for banks, there have been concerns on some margin pressures on banks. But I think probably now margin should stabilize from here on, because this fourth quarter results, when we see that should be the peak of margin moderation. And from next year onward, margin should stabilize. Given the fact banks are at low credit costs and they've underperformed the last 1 year, I certainly see banks performing going into the as we move forward in this financial year. So I would certainly think so, irrespective of the rate cut, these sectors should do well.
Pankaj, are you excited at all about the business updates coming in from HDFC, Bajaj Finance, and of course a clutch of small finance banks, etc.? What do you make of that first cut of numbers?
So one common theme across all of them has been there's been a very strong loan growth. All of these banks, including HDFC, is a separate case because there is a merger event that has happened. But if you look at if you look at the retail loan growth in HDFC Bank, it's still 15%, which is phenomenal on their size, while the overall aggregate loan growth is somewhat moderate because of the merger effect. Other than HDFC Bank, all the other banks have had reported very strong loan growth as well as deposit growth. So I think all of these trends are showing very strong underlying demand momentum in the economy. The good thing from a financial perspective is we are at a point of time where credit cost is historically low. These banks have never had, meaning it's been about, I think 15 years, for last 15 years, they've never had such low credit costs. And I think this benign credit cost environment might continue for some more time. So probably I think the numbers are pretty decent and good in that sense.
You know, we were having a conversation earlier this morning before markets opened with one of our analysts who had this "I told you so" moment. I'm wondering, do you think that those who didn't jump in on an HDFC at 1400, 1500 levels have missed the bus? Is this the sort of turnaround for an HDFC bank and the understanding that the merger overhang will remain for some time, but it's more of a temporary phenomenon?
Yeah, I think so. People who've not owned it so far, they certainly haven't missed the bus because the stock has underperformed for the last 3 years. last 3 years, if you look at HDFC Bank, it's a zero return versus index returns of 20% plus CAGR over the last 3 years, or 18% CAGR at the Nifty level. So I think this is a new HDFC Bank now, because the merged entity is certainly a financial giant with 15% market share in loans and now with mortgages as a new growth engine where HDFC Bank could not participate earlier before the merger. There is a new growth engine in place. So I certainly think that HDFC Bank, let's say from an investment perspective over the next 3 to 5 years, is a attractive investment, this thing. Having said that, given their size and scale, their growth rate will moderate. And I still think that they can grow in line with, let's say, industry growth or a couple of percentage points above that. So if they can do a mid-teens kind of a growth, which is my base case over the next 3 to 5 years, that's still very good for a large, if I could say so, financial conglomerate like HDFC Bank. So I think it's still not late. People haven't missed anything.
Okay. Pankaj, just one quick word before we thank you, and that is that this small turn that we're seeing in pharmaceuticals. Yesterday we were talking, or rather this morning we were talking to Anupam Rasayan, who is won a large order. So some chemical CDMO companies are also talking about that. You track that space closely. We have about a minute left. Are you constructive here?
So CDMO is very exciting as an opportunity, Niraj, across pharmaceuticals and chemicals for India. I think there's a big opportunity there. We have to be selective in stock picking. Chemicals as a space is coming out of 2 years of underperformance. I think the worst is behind. Probably going forward, the sector should do well. So we remain positive on both, but one has to be selective in terms of stock picking, I would say.
Pankaj, we'll leave it at that. Thank you so much for taking the time out and being with us and giving us that perspective. That's Pankaj Murarka, CEO of Renaissance Investment Managers, saying that, I mean, of course, nobody expects a rate cut. The poll of 39 economists on Bloomberg survey, none of them expected a rate cut. So none anticipated now, probably not even in June. The question is only post that, will we have a shallow rate cut cycle, a deep one, or none at all? And that remains in the air. I think the questions today to the Reserve Bank of India will be a lot more on technical factors and not as much on what is the outlook on rates per se. Maybe the global factors and how much of a play they will have when it comes to the inflation expectations for the country. But Tamanna, I dare say, I won't be too surprised if there is a lot of emphasis on what the RBI thinks of growth, because the RBI was ahead of the curve in trying in identifying that the growth numbers might look solid. And then the PMI numbers for India, both the flash PMI and otherwise, have now shown that manufacturing-led growth could actually spur the Indian growth numbers to higher levels than what people had anticipated. So a lot of emphasis on RBI's expectations for growth.
I reckon you might see an upgrade in growth predictions.
Could be interesting to see that.
I think you most likely, because a lot of global agencies have all gone ahead and done that as well. So the 7% growth figure that the RBI has pegged could increase. So that is one thing you will see. Inflation, like Lakshmi was telling us this morning, Niraj, for the next couple of quarters might seem like it's cooling off. But I don't think any central banker right now in the world is going to stick their neck out and say that I need to cut rates. And especially the decrease in dependence on rate cuts to spur pretty much anything. I mean, in real terms, interest rates have gone up, but it hasn't stopped anything. There's Governor Das.
Monetary policy statement of the current financial year 2024-25, and this is how it goes. As you would be aware, earlier this week we commemorated the 90th year of the Reserve Bank of India. The journey of this august institution is closely related to the evolution of the Indian economy. Numerous historic events have occurred during these 9 decades, and they consist of the nationalization of the Reserve Bank in 1949, the planning era, bank nationalization, wars, droughts, the fall of the Bretton Woods system, oil shocks, a precarious balance of payment situation and the subsequent market reforms, the Asian and the global financial crisis, the taper tantrum, and finally the COVID-19 pandemic and the geopolitical hostilities of the recent years. During this journey, the Reserve Bank was always at the forefront, combining its developmental and regulatory roles in steering the Indian financial system and the economy towards stability. While doing so, the Reserve Bank has discharged its responsibility with integrity and professionalism. Compared to many other central banks, the Reserve Bank has a much broader range of functions which is vital for ensuring macro-financial stability of a modern and complex economy like India. There are functional complementarities among the various responsibilities of the Reserve Bank of India. Being a full-service central bank, the Reserve Bank is well positioned to take a holistic view of various critical issues confronting the economy and the financial sector, and it's also well positioned to take appropriate steps in the best interest of the economy. We continuously strive to learn, adapt, and innovate while performing our multiple responsibilities. I would now like to focus on the decisions and deliberations of the Monetary Policy Committee meeting, which met on 3rd, 4th, and today, 5th of April. After a detailed assessment of the evolving macroeconomic and financial developments and the outlook, the Reserve Bank MPC decided by a majority of 5-1 to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is the SDF, rate remains at 6.25%, and the marginal standing facility, that is the MSF rate, remains at MSF rate and the bank rate, they remain at 6.75%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns to the target while supporting growth. I shall now briefly set out the rationale for these decisions. Since the last policy, the growth inflation dynamics have played out favorably. Growth has continued to sustain its momentum, surpassing all projections. Headline inflation has eased to 5.1% during both January and February, and this has come down to 5.1% in these 2 months from the earlier peak of 5.7% in the month of December. Core inflation has also declined steadily over the past 9 months to its lowest level in the series. The fuel component of CPI remained in deflation for 6 consecutive months. Food inflation pressures, however, accentuated in February. Looking ahead, robust growth prospects provide the policy space to remain focused on inflation and ensure its descent to the target of 4%. As the uncertainties in food prices continue to pose challenges, the MPC remains vigilant to the upside risks to inflation that may derail the path of disinflation. Under these circumstances, monetary policy must continue to be actively disinflationary to ensure anchoring of inflation expectations and fuller transmission of the past monetary policy actions. The MPC therefore decided to keep the policy rate unchanged at 6.5% in this meeting and also remain focused on withdrawal of accommodation. The MPC will remain resolute in its commitment to aligning inflation to the target. I would now like to provide an assessment of growth and inflation, and I will begin with the scenario relating to global growth. The global economy has remained resilient with a stable outlook as reflected in various high-frequency indicators. Now, in my statement, whatever I am saying, it is backed up with a lot of data which are there in the footnotes. So those of you who are interested could refer to this statement, which as usual will be uploaded in the RBI website immediately after this statement is over. So a lot of data backing up whatever I am saying is available in the various footnotes of my statement. You may like to refer to it. Let me start again on the global growth part. The global economy has remained resilient with a stable outlook as reflected in various high-frequency indicators. Global trade is expected to grow faster in 2024, although weaker than its historical average. Inflation is moving closer to targets, but the last mile of disinflation is turning out to be challenging. Services inflation in advanced economies remains sticky amidst tight labor markets. Accordingly, central banks are cautious in their communications, thereby tempering market expectations about the timing and magnitude of interest rate cuts later during this year. Equity markets have gained while bond yields and the US dollar have remained volatile. The overall outlook is challenged by continuing geopolitical conflicts, disruptions in trade routes, and high public debt burden. In the last monetary policy statement, if you recall, I had expressed concerns about the high levels of public debt in both advanced and emerging market economies, that is the EMEs. These are dormant risks which could erupt abruptly. Debt to GDP ratio, which rose during the pandemic, remain elevated and are projected to increase further with rising interest burden and cost of borrowing, thus raising debt sustainability concerns. Worsening debt situation in advanced economies, in particular, can generate spillovers for the emerging market economies in the form of swings in capital flows and volatility in financial markets. The emerging market economies with rising levels of public debt in particular would be vulnerable to these spillover effects. Credible fiscal consolidation plans, particularly in major advanced economies, focusing on growth-enhancing investment would be necessary to address this challenge, not only for themselves, but also, I think, for the overall global economy. India, however, presents a different picture on account of its fiscal consolidation and faster GDP growth. Turning to domestic growth, the domestic economic activity continues to expand at an accelerated pace, supported by fixed investment and improving global environment. The second advanced estimates placed the real GDP growth at 7.6% for 2023-24, the third successive year of 7% or higher growth. From the supply side, industrial activity led by manufacturing continued its momentum. The Purchasing Managers Index, that is PMI for manufacturing, displayed a sustained expansion in both February and March, touching a 16-year high in the month of March. Services sector exhibited broad-based buoyancy with all sectors within the services sector registering strong growth. The PMI services remained above 60 during February and March, suggesting sustained healthy expansion. With rural demand catching up, consumption is expected to support economic growth in 2024-25. Urban consumption stayed buoyant, as evident from various indicators. Details are given in the footnote. The resilience in cement production, together with strong growth in steel consumption and production and import of capital goods, augur well for the investment cycle to gain further traction. The total flow of resources to the commercial sector from banks and other sources at rupees 31.2 lakh crore. I repeat, at rupees 31.2 lakh crore during 2023-24 is significantly higher than that of the previous year, which was 26.4 lakh crore. External demand improved in February, with exports registering double-digit expansion. Trade deficit, however, widened in February as imports also accelerated. Going forward, the outlook for agriculture and rural activity appears bright. With good Rabi wheat crop and improved prospects of Kharif crops, due to expected normal southwest monsoon. Strengthening of rural demand, improving employment conditions and informal sector activity, moderating inflationary pressures, and sustained momentum in manufacturing and services sector should boost private consumption. Let me read this sentence again because there are quite a few points in this. Strengthening of rural demand, improving employment conditions and informal sector activity, moderating inflationary pressures, and sustained momentum in manufacturing and services sector should boost private consumption. As per our survey, consumer confidence 1 year ahead reached a new high. The prospects of investment activity remained bright owing to upturn in private capex cycle becoming steadily broad-based. Persisting let me just rephrase it. The prospects of investment activity remain bright owing to upturn in private capex cycle becoming steadily broad-based, persisting and robust government capital expenditure, healthy balance sheets of banks and corporates, and rising capacity utilization, and finally strengthening business optimism as reflected in our surveys. I think the sentence is a bit long. It's better that I read it out again for greater clarity. And sorry about that, but I think it provides greater clarity. The prospects of investment activity remain bright owing to upturn in private capex cycle becoming steadily broad-based, persisting and robust government capital expenditure, healthy balance sheets of banks and corporates, rising capacity utilization, especially in the manufacturing sector, and strengthening business optimism as reflected in our surveys. Improving global growth and trade prospects, coupled with our rising integration in global supply chains, are expected to propel external demand for goods and services. The headwinds from protracted geopolitical tensions and increasing disruptions in trade routes, however, pose risks to the overall outlook. Taking all these factors into consideration, the real GDP growth for the current financial year 2024-25, which started on 1st April, the real GDP growth for 24-25 is projected at 7%, with Q1 at 7.1%, Q2 at 6.9%, and both Q3 and Q4 at 7% each. The risks are evenly balanced. Turning to inflation, food price uncertainties continue to weigh on the inflation trajectory going forward. A record Rabi wheat production would help temper price pressures and replenish the buffer stocks. As you would recall, the buffer stocks had slightly dipped, but I think the record Rabi production of wheat is expected to replenish whatever depletion had taken place. Moreover, early indication of a normal monsoon augurs well for the Kharif season. International food prices also remain benign. The tight demand-supply situation in certain categories of pulses and the production outcomes of key vegetables warrant close monitoring, especially in the background of the forecast of above normal temperatures in the coming months. And these above normal temperatures, as per the current forecast, are expected to prevail in April, May, and June, and not beyond June. That is the current forecast. Frequent and overlapping adverse climate shocks pose upside risks to the outlook on international and domestic food prices. Cost push pressures faced by firms are seeing an upward bias after a period of sustained moderation. Deflation in fuel is likely to deepen in the near term, following the cut in LPG prices in the month of March. Notwithstanding the cut in petrol and diesel prices in mid-March, the recent uptick in crude oil prices, especially in the recent few days, they need to be very closely monitored. Continuing geopolitical tensions also pose upside risk to commodity prices and supply chains. Assuming a normal monsoon next year, CPI inflation for, when I say normal monsoon for next year, I mean the current year 24-25. CPI inflation for the current year 24-25 is projected at 4.5%. I repeat, CPI inflation for the current year 24-25 is projected at 4.5%, with Q1 at 4.9%, Q2 at 3.8%, Q3 at 4.6%, and Q4 at 4.5%. The risks are evenly balanced. Now, what do these inflation and growth conditions mean for monetary policy? I have explained the growth situation, I have explained the inflation scenario. Synthesizing everything, what does it mean? What implications it has for monetary policy? And that is precisely what I would like to explain now. Inflation has come down significantly but remains above the 4% target. Food inflation continues to exhibit considerable volatility, which is impeding the ongoing disinflation process. High and persistent food inflation could unhinge anchoring of inflation expectations, which is underway. Our ongoing effort is to ensure fuller transmission of policy actions and anchoring of household inflation expectations. The strong growth momentum, together with our GDP projections for 24-25, give us the policy space to unwaveringly focus on price stability. Now, 2 years ago, around this time, when CPI inflation had peaked at 7.8% in April 2022, the elephant in the room was inflation. The elephant has now gone out for a walk and appears to be returning to the forest. We would like the elephant to return to the forest and remain there on a durable basis. In other words, it is essential in the best interest of the economy that CPI inflation continues to moderate and aligns to the target on a durable basis. Till this is achieved, our task remains unfinished. The success in the disinflation process so far should not distract us from vulnerability of the inflation trajectory to the frequent incidents of supply-side shocks. Our effort is to ensure price stability on an enduring basis, paving the way for sustained period of high growth. I would now like to turn to the aspect of liquidity and financial market conditions. In the February monetary policy statement, if you recall, I had mentioned that liquidity conditions were driven by exogenous factors which were likely to correct in the foreseeable future. Liquidity conditions eased during February and March in the wake of increased government spending, Reserve Bank's market operations, and the return leg of US dollar and Indian rupee sale by swap auction, which had been done earlier in 2022. In particular, liquidity situation improved in March, with system liquidity turning intermittently surplus in the first half of the month. In these circumstances, the Reserve Bank conducted 14 fine-tuning variable rate repo operations, that is VRRR operations, during February and early March to absorb intermittent surplus liquidity. Anticipating the seasonal tightening of liquidity at end March, the Reserve Bank injected liquidity through variable rate, that is VRR operations, both main and fine-tuning operations. Consequently, the average borrowings under the MSF window moderated. Liquidity conditions have, however, again turned surplus from March 30th, necessitating VRR auctions from 2nd of April. So you would have noticed in the last 2-3 days, we have been conducting more than one VRRR auctions. On 2nd April, then again we did it on 3rd April. So last 2-3 days we have been doing it. And today, as you know, there is a variable rate, what you call, as per our cycle, we are doing VRR operation for 14 days. A VRRR operation for 14 days. Now, reflecting these liquidity developments, The weighted average call rate, that is WACR, exhibited a softening bias and has hovered near the repo rate since the last policy meeting. In tandem, rates in the collateralized segment of the call money market have also softened. Financial conditions remained conducive as reflected in reduced term spread in the G-Sec market and stable risk premium in the bond market. In the credit market, monetary transmission continues to be work in progress. Looking ahead, the Reserve Bank will remain nimble and flexible in its liquidity management through both main and fine-tuning operations in both repo and reverse repo. We will deploy an appropriate mix of instruments to modulate both frictional and durable liquidity so as to ensure that money market interest rates evolve in an orderly manner that preserves financial stability. The Indian rupee has remained largely range-bound as compared to both its emerging market peers and a few advanced economies during the financial year 2023-24, that is till 31st March last. The Indian rupee was the most stable among major currencies during this period. This is very important. The Indian rupee was the most stable among major currencies during this period. As compared to previous 3 years, the Indian rupee exhibited lowest volatility in 2023-24. The relative stability of the Indian rupee, which I just mentioned, it reflects, I would emphasize, the relative stability of the Indian rupee reflects India's sound macroeconomic fundamentals, financial stability, and improvements in our external position. Turning to financial stability, let me say that latest data as at end December 2023 show that the key indicators of capital and asset quality of scheduled commercial banks continued to be healthy. The financial indicators of non-banking financial companies, that is NBFCs, are also in line with that of the banking system as per the latest data available. Let me emphasize here that banks, NBFCs and other financial entities must continue to give highest priority to quality of governance and adherence to regulatory guidelines. Financial sector players by and large operate with public money, be it of depositors in banks and select NBFCs or investors in bonds and other financial instruments. They should always be mindful of this aspect. The Reserve Bank will continue to constructively engage with financial entities in this regard. It needs to be recognized that financial stability is a joint responsibility of all stakeholders. The Reserve Bank has also been engaging with the regulated entities and various stakeholders for simplifying its regulations and reducing compliance burden. As part of this endeavor, the recommendations of the Regulations Review Authority RRA 2.0 constituted by the Reserve Bank have been largely implemented. The RRA 2.0 has set a new benchmark for meaningful engagement between the regulator and the regulated entities. Moving further in the same direction, internal review groups within RBI were formed in 2023 to rationalize, simplify and remove obsolete regulations and streamline the reporting mechanism. In pursuance of the recommendations of the RRA 2.0, that is the Regulations Review Authority which was constituted by the RBI. So in pursuance of the recommendations of the RRA 2.0 and the internal review groups which we constituted in 2023, more than 1,000 circulars have been withdrawn. A master direction for rationalizing and harmonizing supervisory returns has also been issued. The Reserve Bank will continue to follow a consultative approach and undertake review of regulations in line with the evolving financial landscape. Turning to external sector, during the first 3 quarters of 23-24, India's current account deficit narrowed significantly on account of a moderation in merchandise trade deficit, coupled with robust growth in services exports and strong remittances. India's merchandise and services exports have grown at a healthy pace in the fourth quarter of 23-24. India continues to be the largest recipient of remittances in the world. The cost of receiving remittances is gradually coming down. Overall, the current account deficit for 2024-25 is expected to remain at a level that is both viable and eminently manageable. On the external financing side, India's foreign portfolio investment, that is FPI flows, saw a significant turnaround in 23-24. Net FPI inflows stood at $41.6 billion during 23-24, as against net outflows in the preceding 2 years, which were in the order of 14.1 billion outflow in 21-22 and 4.8 billion outflow in 22-23. This is the second highest level of FPI inflow after 23-24. Net foreign direct investment moderated to $14.2 billion in April-January 23-24 from 25 billion a year ago. External commercial borrowings, that is ECBs, and non-resident deposits recorded higher net inflows compared to the previous year. The amount of ECB agreements also grew markedly in 2023-24 up to February 24. Now, all this data is given, details are given in the footnote. India's foreign exchange reserves reached an all-time high of $645.6 billion as of March 29th this year, March 29, 2024. I repeat, India's foreign exchange reserves reached an all-time high of $645.6 billion as of March 29, 2024. Latest data on various external vulnerability indicators suggest improved resilience of India's external sector. We remain confident of meeting our external financing requirements comfortably. Now, talking about the forex reserves, I recall that in 2021, our forex reserves had also reached 642 plus billion Then following the commencement of the war in Ukraine and the outflow of dollar from India as well as from several other countries on safe haven demand, there were concerns that forex reserves of India was going down, and at one point it had gone down. Our forex reserves had gone down to about $524 billion. And at that time, I think several questions were raised about, what was RBI doing, whether RBI was on the right track. If you recall, at that time, we had very clearly assured that the decline in forex reserves was partly due to, the change in valuations of our assets, and also partly due to our intervention in the market to ensure an orderly depreciation of the rupee, which is a part of our policy, ensuring orderly depreciation or orderly appreciation. And we had that time very clearly and firmly stated that we are using our forex reserves in a very judicious manner. It was a strong umbrella which we had built up, and we are using it because it was raining heavily. And we were mindful of what we were doing. We knew what is our purpose and in which direction we are moving. And as you would see, now the reserves have again risen, and they stand at an all-time high of $642.6 billion, 645.6 billion as of 29th March. So, this is one area on which the Reserve Bank remains committed. Number one, to sort of ensure that, the exchange rate of the rupee is market determined. There are inflows and outflows of dollars happening. But it is our focus, it is our prime focus to build up a strong umbrella, a strong buffer in the form of a substantial quantum of forex reserves, which will help us when the cycle turns or when it rains heavily. So let me move forward. Sorry for the digression, but I thought it was necessary to set the record straight. I shall now announce certain additional measures. The first announcement relates to trading of sovereign green bonds in the International Financial Services Center, IFSC, with a view to facilitating wider non-resident participation in sovereign green bonds. A scheme for investment and trading in these bonds in the IFSC will be notified very shortly. The second announcement relates to the RBI Retail Direct Scheme and introduction of a mobile app to operate in the RBI Retail Direct Scheme. The Reserve Bank Retail Direct Scheme was launched in November 2021 for enabling the retail investors to participate in the GSEC market, both in the primary as well as in the secondary market auctions and operations. It is now proposed to launch a mobile app for accessing the Retail Direct portal. This will be of great convenience to retail investors and deepen the GSEC market further. The next announcement relates to review of liquidity coverage ratio, that is LCR framework. Technological developments have enabled bank customers to instantly withdraw or transfer money from their bank accounts. While improving customer convenience, this has also created challenges for banks to deal with potential situations when, due to certain factors, a large number of depositors decide to instantly and simultaneously withdraw their money from the banks. The developments in certain advanced jurisdictions during the last year demonstrated the difficulties it can create for banks. The difficulties it can create for banks to deal with such situations when there is heavy outflow of, heavy outflow or transfer of deposits. And this happens only if that particular bank is in an acute stress. It's not a normal thing which happens, but then the banks will have to remain prepared for all eventualities. A need has therefore arisen to undertake a comprehensive review of the LCR framework for banks. A draft circular will be issued shortly for stakeholder consultation. Our approach is to have a balanced approach, and as I said a little while ago, we follow consultative approach, so therefore the draft circular will enable the stakeholders and the banks to give their views and opinions and suggestions, which will be taken into consideration by the Reserve Bank before arriving at a final decision. The next announcement relates to dealing in rupee interest rate derivative products for small finance banks. At present, small finance banks are permitted to use only interest rate futures for proprietary hedging. It has now been decided to allow small finance banks to use permissible rupee interest derivative products. This will allow further flexibility to small finance banks for hedging their interest rate risk and enhancing their resilience. The next announcement relates to enabling UPI for cash deposit facility. Deposit of cash through cash deposit machines, that is CDMs, is primarily being done through the use of debit cards. Given the experience gained from cardless cash withdrawal using UPI at the ATMs, it is now proposed to facilitate deposit of cash in CDMs, that is in the cash deposit machines, using UPI. This measure will further enhance customer convenience and make currency handling process at banks more efficient. And the next announcement relates to, I have two more announcements and I shall be quick. Next announcement relates to UPI access for prepaid instruments through third-party apps. At present, UPI payments from prepaid payment instruments, that is PPIs, can be made only by using the web or mobile app provided by the PPI issuer itself. It is now proposed to permit the use of third-party UPI apps for making UPI payments from these PPI wallets. That means the PPI wallet holders no longer have to be completely dependent on the PPI issuer, but they can use any other third-party app which is operating under the UPI. This will further enhance customer convenience and boost adoption of digital payments for small value transactions. And the final announcement relates to distribution of central bank digital currency, that is CBDC, the e-rupee, through non-bank payment system operators. The CBDC pilots are currently in operation with increasing number of use cases and participating banks. It is proposed to make CBDC retail accessible to a broader segment of users by enabling non-bank payment system operators to offer CBDC wallets. This will facilitate testing of resiliency of the CBDC platform to handle multi-channel transactions. Let me now conclude, and I would like to state that as we progress towards RBI at 100, the upcoming decade is going to be a transformational journey. The Reserve Bank will continue to focus on preserving financial stability and promoting a system that is robust, resilient, and future-ready. And it will be robust, resilient, and future-ready to support economic growth. Price stability will be a key component of this endeavor. Turning to the present, inflation is on a declining trajectory and GDP growth is buoyant. At this juncture, we should not lower our guard, but continue to work towards ensuring that inflation aligns durably and sustainably to the target. Our goal is in sight, and we must remain vigilant. We are inspired by the profound words of Mahatma Gandhi, and I quote, "One must persevere and have patience. Success is the inevitable result of such effort." Thank you. Namaskar.
Well, quite a policy statement, though, must say. Not much in terms of action or even takeaways on the growth front or otherwise. So the two things that stood out for me, Tamanna. One, I love the dialogue. In the past, the elephant in the room was inflation. Now it's gone for a walk, heading to the forest. But that notwithstanding, two things. One, we'll continue unwaveringly focusing on inflation, saying that MPC should remain disinflationary. So the focus is on inflation and not growth thus far. Maybe growth is taking care of itself, though they didn't raise the targets. And RBI will continue to constructively engage with financial sector entities. I believe a lot of questioning will happen in a press meet. I think those two stood out for me.
So the other bit on inflation, which stood out for me, was when he said that till we don't reach our target, our work is not done.
Yeah.
And then you look at the inflation outlook for the next 4 quarters, and there is no case right now to understand why they would cut rates, because that target is not in sight. 4% is the target. Now, in none of those quarters is 4% in sight. So,
except for quarter 2, but which is just a passing thing, 3.9%.
Yeah, so that's neither here nor
passing,
there.
Yeah.
The year is 4.5%. So you're way off. So now that makes me wonder whether you're going to have a rate cut this year at all. In terms of dialogues, umbrella was my favorite. You know, when he talked about how the RBI was criticized when forex reserves came down, he said we had an umbrella, there was heavy rain, we used it. Now we've built it back up. Anyway, so a lot of interesting things to unpack over here. Jayesh Mehta is with us. He's VC and CEO of DSP Finance. Tanvi Gupta Jain, UBS's India economist, also with us. Welcome to both of you. Thank you so much for speaking with us on the show on NDTV Profit. Jayesh Mehta, let me begin with your first take. What was the outlook that you really saw coming through in terms of a rate cut timeline?
I think as per expectation, it was very clear we're not going to touch rates, and as you just said, till we reach 4, or US cuts rates. So, you know, from that perspective, I think nowadays it's a little bit dicey whether US may actually cut rate or not. So that's a question mark which is coming in. But having said that, growth is taking care of itself. That's what you just said recently. Inflation at 4.5 for second half from second quarter onwards. We still have some room to cut rate, because at the end of the day, you know, one has to really look at it like 2% real rate on repo. That may, you know, fizzle down growth if it continues for a longer period. So at some point of time, whether international market cuts rates or not, we may still have to cut rate, provided you know, the global geopolitical, oil price, rainfall, everything remains as per projected.
All right, so it might, so either Fed becomes the trigger or we hit 4, maybe at 4.5% as well. So I suppose Q2 onwards, the case gets stronger. Tanvi, very good morning to you as well. You know, your take on the rate cut sort of comments and what you glean out of it. And also perhaps, were you surprised that the target for next year for growth continues to be at 7% when you've seen such robust data coming in?
Sure. So let me start with, what is my take in today's policy. So if I look at the way Indian economic growth on the ground remains robust and a manageable macro stability risk, we clearly were of the view that there is no urgency for the MPC to either change the policy setting, whether it means rates or stance at this juncture. But going forward, I think I would say, looking at the policy, RBI was sounding a little cautious, largely on two counts. One, we are seeing global oil prices have moved higher over the last few days. They are hovering at around $90 a barrel, plus uncertainty on the food prices. I mean, if I look at Indian Met Department recently forecasted longer heat wave between April to June. I mean, whenever we have seen warmer temperatures, we have seen vegetable prices, fruit prices. There's a possibility of them, of the prices to go up. So clearly, there is a lot of uncertainty on the food inflation bit. Going forward, beyond June, we are all expecting that La Nina, which typically brings more rainfall, will set in by June. So hopefully, a monsoon season between June to September, we end up seeing a normal monsoon, which will help keep food prices in check. But at this point, obviously, you need to price in, because RBI categorically is highlighting that the medium-term target is to take CPI down to 4%, and then they're not happy to CPI hovering at a rate which is much higher. I mean, currently it is trading at 5.1. The expectation is that the March inflation print will be somewhere between 4.8. That is what our estimate is. On the rate cut assumption, we still have a shallow easing cycle in our FY25 policy rate forecast, but that too is a function of three things. One, how the weather uncertainty will play out. Second is oil. Third is, and the most important, is that Fed pivot. So as of now, we are also estimating a June rate cut by the US Fed, but looking at how the US data has been surprising on an upside, in case it gets pushed forward, I think it will be very difficult for RBI to go ahead and start cutting rates. So as of now, we do have a shallow easing cycle, mostly backdated, and will also be a function of how the global monetary easing pans out over this year.
Tanvi, good morning, Niraj here. Is the context such a bad thing, considering that the RBI is not forced to go ahead with any kind of rate decision, simply because global growth and India growth by itself within the current interest rate scenario also seems to be doing okay?
Absolutely. I mean, India's growth is doing very well. I mean, people are talking about whether India's growth has decoupled, which never is the case, but definitely Indian economy has been holding up very well. The other point which, Niraj, I think we should all take into account, I think which Jayesh also mentioned, is that a real policy rate, which will start moving into restrictive territory from September onwards because of faster than expected disinflation. So in case you do see in the September quarter that the CPI inflation is falling below 4% and your repo rate is still at 6.5%, you're actually talking about 250 basis point real rates in India, which definitely could be constraining growth. So the point is, we need some fine balance at some point in time, whether we want to wait for the Fed pivot to happen, or we need to wait for how the global macroeconomic dynamics are panning out over the coming months.
Actually, Jayesh, coming on that, that's an important point. We do, let's assume the RBI's assessment of 3.9% is correct for Q2. We hit circa those levels. Real rates remain high. What does the RBI do? Because it's shown its hand saying that that is passé, because Q3 and Q4 the numbers will be higher and average is still 4.5. So what do you expect the central bank to do in the ensuing two policies when these real rates are these high?
I think, by end of second quarter, right, you will get over the weather. If there are a few cautions, right, weather, crude prices, once you get over that, and of course, you don't have any new geopolitical situation. For us, geopolitical situation means basically crude price remaining stable. If that, or supply chain not getting disrupted. Now, if that are the scenarios, even at 4.5 for the annual year, right? Because last quarter also they mentioned 4.5. I still think that they will definitely go for some cut once everything is envisaged. Right now, it's all about projections, subject to rainfall, subject to climate, subject to geopolitical, crude oil, and all that. Now, if that clarity gets by second quarter, maybe then they have room to at least show some softness and support the growth at that point of time.
Yes, sorry, just to rewind this, you would expect the central bank to take a rate decision even if the Fed were not to take that decision at that point of time?
Absolutely, absolutely. Because you see, if everything is projecting out, so they don't need to really wait till 4% to actually cut the rate, right? So if it is 4.5, and if they think, as you said in the beginning, elephant is not coming back from forest because by that time they will project first 2 quarter of next financial year. If they think that it is maintainable, then they would definitely go for that. Naturally, if it is next quarter forecast looks more than 4.5, then they may still not do it.
So will they, won't they? Obviously that debate continues, but another couple of statements that I found as a positive surprise in how assertive they were, and I'm coming to Tanvi Gupta with this question, is on rural demand catching up. And saying that consumption will support economic growth going forward. He's saying urban consumption remains buoyant and the outlook for agri and rural activity is bright. All of this, of course, based on a normal southwest monsoon. Now, in the real world, you're still seeing that distress. You're looking at business updates coming in from FMCG players, consumption companies, and they're still seeing that distress. Are we now on the ground going to be seeing a change in that narrative? Was that fairly clear from what the governor was saying?
Sure. So if you look at on the ground consumption indicators, we can clearly see there's quite a wide gap between affluent Indian consumption holding up, whereas the demand for the low middle class and the low income consumer is actually slowing down. And it is showing up in data in most of the FMCG companies' data. You can clearly see that there's a clear divergence between the affluent versus the not so affluent consumer demand. So going forward in FY25, if we end up seeing a normal monsoons and inflation remains on a decelerating path, so we are also of the camp of a 4.5% inflation for India, there are two positive things on the consumption bit. One, you will see that rural consumption will begin to improve, which was quite mixed last year. If I look at rural consumption, we did see a lot of supply side intervention by the government last year in a bid to control inflation. For example, there were export bans announced on rice, wheat, etc., which if we end up seeing a normal monsoons, my first expectation was that all these export bans gets reversed, which will bode well for the rural consumption also because their income power or the income levels will go up. The second is whenever inflation is falling, it actually bodes well for the real household disposable income. Again, bodes well for the consumption perspective. So going into FY25, in our base case, we also have a consumption pickup or improvement versus FY24 in our forecast, largely driven by the rural consumption improving. And it should start showing up in numbers in the September quarter onwards. I don't think so. It will start showing up in numbers at least in the next 2 to 3 months.
Jayesh, you have a take on this, that are we seeing the first signs or at least a sort of, I would say, first declaration that the rural consumption pain story might be shifting coming from the governor?
I think governor and I think some of the researchers are also saying that that pain kind of shifting. So that is what I'm hearing, but I really would not have much take on that situation. But yeah, that's what it's more like I did hear from 1 or 2 research guys also last week that that change is changing.
Okay. Just one quick word on the currency. I mean, we don't need the RBI governor, of course, to tell us that it has been very stable. We know it has been. But just the fact that there are so many global factors that play out here too, flows notwithstanding, the reserves are still high. Do you think the average pace of depreciation of the currency improves, or does the currency become a headache of some sorts for the Reserve Bank during the course of the rest of the year because of geopolitics?
I think we people were expecting us to appreciate our currency to appreciate, and we still believe that with your JP Morgan index inclusion and stuff. But at the same time, we have to see other export economy. They depreciate much. We cannot really appreciate. So I think we'll have to see that trend. And I'm talking about mainly China. And that's where it would be maintaining parity. If they depreciate, we would depreciate a little bit, and they may let it go from that perspective. But otherwise, overall, if everything geopolitical and all that stuff are better, we should look at some appreciation post June onwards when the flow starts. And of course, also the election would be behind us, right? So both the things matter. Niraj, I just want to highlight one point, very important, which has been made in the announcement. Actually, 2 points. One is green bond in IFC. We have to see the detail how it will work, but that's a good start. And very important is retail direct mobile app, right, by RBI. So that's something, a game changer. I think 2 more steps required going forward is to allow, just like equity, others also do it, and at some point of time, repo for retail. So these are the things going forward, but this is a very good start. What they have done is to get retail mobile direct app. This will be by RBI, but of course, we have to see the guideline how it comes.
Okay, so before me and Tamanna ask something to Tanvi, because I have a question on growth too, but Jayesh, green bonds, I mean, why do you think it is such a game-changing thing?
No, it's more than green bond. It is, I would say, it is the mechanism. So the mechanism of NRIs and others. So you are basically widening the market. Green bond is just the start to do it at IFC. So this is actually, so that's what I said, like, it's a good start. It's right now, today is green bond, tomorrow it could be something else, right? So it's a good start to look at, but we still need to see that. And I think retail direct is a big one. I personally had been asking for it for a long time. So finally it's come through.
You have now an investment, a class of investors who are have increased appetites and want to look at different options. So yeah, that'll be interesting to follow. Tanvi, I just want to sort of come back to a question I asked you earlier, and it was bunched up with the inflation one, so perhaps we didn't get a chance to address it properly. But again, on the 7% growth outlook, yes. All things considered, you are the bright spot, that is India. Everything is looking good. Your high frequency data is your PMI manufacturing service pointing out to robust growth. Then why just 7%?
Okay, so if you look at, we do see upside risk to even FY24 second advance estimate by CSO, which is 7.6. So in case that number is closer to 8%, because as you mentioned, and my lead indicator is telling me that the economic momentum on the ground is very robust, you might see that FY24 number or the growth would actually surprise on an upside versus what the CSO second advance estimate of 7.6 is saying. If there is an upside surprise in FY24 number, I would say at that point, FY25 growth of 7% looks very, very reasonable. In fact, at UBS also, we have a forecast of a 7% GDP growth for FY25. You need to take into account that when you look at FY24 number, there were a couple of statistical nuances which were at play. There was a base effect and there was a significantly lower GDP deflator, which is not going to be the case in FY25. So FY25 on a like-to-like basis, a 7% growth adjusted for the statistical nuances of FY24 is actually showing a good recovery, and it is in line with what the high-frequency data on the ground is telling you. Okay. So I think I was more of the camp that the GDP growth will not get revised upwards, and looks like this is where RBI is also standing on the FY25 GDP growth estimates.
So it's not that the RBI is being too careful, but the statistical sort of, when we saw that 8.1% quarterly number, etc., so the statistical sort of alterations and aberrations have been accounted for. But yeah, that's an important thing. So high growth, inflation cooling off, and the markets are responding to what we are seeing as well, isn't it, Niraj?
Yeah, just actually, before we take the next question, Tamanna, that's a good cue. Just mark what the indices are doing as well, because it's not that all banks are doing well, by the way. Selectively, some banks are doing well. HDFC in particular piling on the gains, but it's not that everything else is doing well, because the likes of ICICI, Bajaj Finance, Axis Bank, etc. are down as well. So just a quick marking there. There's a bit of a lone star phenomenon there in terms of HDFC Bank. Just one quick word, Tanvi, on what is often repeated but mentioned again by the Reserve Bank. This is my last question to you, of course, on this private capex optimism, which is very selective, even though everything else, which is government capex, healthy balance sheet, rising capacity utilization, all well known. But yeah, private capex optimism, not necessarily quite visible, but the RBI governor reiterating it 2 policies in a row.
Okay, so if I look at the private corporate capex and look at where are we seeing based on the data of 4,500 companies that we track, which I would say largely account for the bulk of the corporate capex in India, there is a pickup, but it is not broad-based. It is again led by a few selected companies rather than expecting a broad-based private corporate capex recovery, which would have been the case because the underlying drivers of capex are well in place. The corporate balance sheet has been deleveraged. Banks' asset quality concerns remains very manageable, more than happy to lend, and they are lending towards consumption. I really hope that the demand for investment loans actually comes in, which will lead to a much more sustainable credit growth cycle. But at this point, the prospects for private corporate capex are definitely bright, but it is not showing yet in terms of a broad-based corporate capex recovery. The hope is post-elections, it gathers steam, but we are actually, if you look at my capex growth numbers for FY25, there is some deceleration in overall capex. We are expecting it to gather steam mostly in FY26. If I specifically look at the private corporate capex growth forecast going forward.
Yeah, absolutely. Another positive is the governor talking about how their consumer confidence survey shows for the next 1 year shows a completely upbeat sort of outlook from Indian consumers. So that's sort of a thumbs up as well. Thank you so much, Jayesh and Tanvi, for joining us on this leg of our coverage as we break down the RBI monetary policy announcement and what it means. Of course, no change in rates as was widely expected. Inflation numbers at 4.5% for the next financial year. That's the target. Growth at about 7%. What has reacted in the markets? Well, nothing much really, to be honest. Banks are relatively better in an otherwise flat market completely. On the Nifty and Sensex, you're not seeing much movement at all. Let's pull up what the broader markets are doing, because it's pretty much just the bank Nifty showing some resilience. But yeah, your mid-cap index about 0.5% up. Your small cap also about 0.5% up, but nothing much happening there. When I talk about banks, and Niraj is absolutely right, Lone Star kind of a show, HDFC Bank. Some, of the smaller players doing well, Aavas and Equitas, all of these kind of, players are showing some movement. Aavas Finance up about 7%. Equitas, small finance bank, has actually given up some of its gains through the day. So some volatility coming in. There was an announcement from the RBI, but we have to wait and see what it goes into in terms of allowing a larger coverage of derivatives trade for small finance banks. So AU Small Finance Bank also about 1% up. But we'll have to delve into that a little deeper. Apart from banks, pharma has been having a good day. And perhaps that's a bit of a defensive play.
Yeah, and maybe this US policy about a new health package, etc. Who knows? All of that could be in focus. But yeah, a sector wherein select pockets haven't done well for quite some time turning around. Let's wait and watch. But just round off this piece that me and Tamanna are doing on the policy with one more expert before we call it today. And that is Anurag Mittal, Head of Fixed Income at UTI Asset Management, joining us right now on the show. Anurag, really appreciate you taking the time out at this last moment and talking to us. Niraj here, good morning. What did you make of the policy from somebody who manages a book of fixed income? Did this bring about any material changes for you?
We think the policy is BAU, and it's largely in continuation of the Feb 2024 policy. If you see, there was a 5:1 voting with members voting to retain the stance as well as retain the repo rate. I think RBI rightly is not going towards a pre-committed path, given the uncertainty and unpredictability of food inflation. And I think they are reiterating that they want to have a strong visibility on that 4% inflation target before they take any major rate action. We believe that market was largely anticipating this policy. So even from a market perspective, it's not really any surprise. And I think with policy now out of the way, going ahead, probably, bond market will be looking at how inflation and especially food inflation pans out in the near term.
Anurag, the rhetoric at the start of the year or maybe last quarter of the previous calendar was a great time to buy into fixed income funds simply because we're seeing an interest rate trajectory which is headed lower. Now, if at all we'll see a shallow one, who knows, even that might get altered. I don't know if you think differently. Right. My question is it better to space out that investment piece, or are you firmly believing that yields are headed lower, rates are headed lower, and bonds are headed higher?
So thanks for that. So see, we do expect about 50 to 75 basis of rate cut in this monetary policy cycle, probably in the next 6 to 12 months. I think one good thing which has happened in the last 12 months is meaningful repricing of even the moderate duration of the yield curve. So even if you look at the 3 to 4 year part of the yield curve and AAA bonds, they're yielding anywhere between 770 to 780 and thereabouts. So investors don't have to take meaningful duration risk. Even if they look at high credit quality, moderate duration products, they are giving them very attractive accrual and opportunity to participate, in some amount of capital gains as the rate cycle starts. Like you rightly said, probably it's a shallower rate cycle with too much fluidity around. So probably it makes sense to stick to moderate duration rather than go for very long end of the yield curve.
Absolutely. The uncertainty has not become too much clearer after the policy announcement, all in all. Yeah. Anurag, thank you so much for your time. Great to have you on the show. And with that, we're wrapping out this leg of our coverage on the monetary policy, impact on markets, etc. But it's just a very short break, and we'll be right back with a lot more updates on what is happening in the markets. Stay tuned.